All right, everybody. Good evening. That was my best Amit impression. Sorry. So the show has to go on. The community needs this more than anybody. Amit needs his rest. God forbid the guy takes a damn day off. So for goodness sake, you guys, I'm sure, need something to do for at least 30 minutes or half an hour. We need to get this figured out. We need to see the market close. Let me see. I think I have a bell somewhere, so I need to get prepared for that. I'm not ready at all, but I literally 10 minutes ago was on my phone, about to pull up the stream, and saw that Amit, unfortunately, is not feeling 100%. So I was like, you know what? The show has to go on. And I was like, let me get out of bed. I was about to take a nap. I'm also not feeling 100% myself. But I was like, you know what, man? Like, the community needs this. And I always see the real showmanship that Amit does, and it always inspires me. Now I'm just trying to convince the goddamn milkman to come on. I was like, hey, man, like, you ready to come on the show? And he's like, Amit's not going to be on. I was like, well, are you just going to not come on the show if I do it? Like, I thought we were bros. But we will see. Let's see if Hot Steve will join. It looks like he may. So let me make sure he gets the link. Sorry if this is seeming like it is completely disjointed, because it is. I was not prepared. It's also high pressure, high stress. I don't have nearly the good looks, the GQ-like looks, the showmanship of Amit, nor do I have everything prepared. But what I can do is go across some of the companies that I follow, and we can just get into some of the interesting things that have been going on today. I know that you guys have already talked about trade tensions and a bunch of other different things that are going on today. The things that I'm most seeing that are up, which is absolutely insane, and let me share my screen, is this guy. Up 12% today after absolutely destroying earnings reports earlier today. I'm curious if in the background, if there's anything from CNBC. I was working up until about half an hour ago, and then I was going to take a quick nap because I wasn't feeling 100%. But curious what Ford has to say, if Jim Farley or anything like that has anything to say. And it looks like right here we do have something from a former Ford CEO. So I'll let the ad play through. I'm curious to see what they have to say. But I'm curious because this is going to be interesting to kind of hear specifically about how the EV markets really transition away from what's going on with tariffs and everything and the like. So let's share this over and hear what they have to say.
And Ford beating on earnings but lowering guidance after a fire hit operations at the manufacturing plant of their primary aluminum supplier last month.
In fact, here to help us break down the Ford quarter, what it means for the rest of autos, is former Ford CEO Mark Fields, also a CNBC contributor. Mark, happy Friday. Thanks for being with us.
Great to be here, Carl. Thanks.
What a week between the fire, which we'll get to in a second, but tariff expectations, Ford's comments about EVs. What do you think is most important right now?
Well, I think when you look at the industry right now, the things that are most important for all the automakers are, first off, really trying to gauge demand, both on internal combustion side and the EV side, and then take appropriate pricing, and most importantly, get their cost structures in line for an industry that faces increasing global competition. But Carl, when you look at the results of Ford or even GM, in Ford's case, they had a strong quarter. They beat on the top and bottom lines, just like GM. And just like GM, they had very strong, truck and SUV sales. So you're seeing the market react positively overall to particularly the domestic OEMs, where the government just extended the tariff relief on imported parts. In Ford's case, they get an advantage because medium and heavy duty trucks that are not produced in the U.S. are now taxed. And for, particularly Ford, GM, and Stellantis, the fact that the government has relax the fines, if you will, on the fuel economy requirements, which will allow them to sell more trucks and SUVs. But it's really gauging that and getting your cost structure in line for an industry that is being attacked by the Chinese domestic manufacturers.
Right. Do you think we turned a bit of a corner chapter-wise when it comes to full EVs and what they will contribute to the overall share of U.S. sales?
Well, I think, you're going to see obviously a pullback given that the federal incentives have come off. But I think you're going to see a gradual growth in the EV market. I mean, let's face it, Carl, eventually, oil is a non-renewable resource. So you're going to see these grow over time, but it's not going to be at the pace that the automakers thought. And that's why you're seeing these big impairment charges that both Ford and GM and others have taken. And I think you're going to see more going forward as the industry adjusts to a new demand curve, if you will, for EVs.
How would you characterize just the overall health of the auto sector right now? I asked this in the context of several pretty high-profile bankruptcies that kind of played into this space. And I'm curious if you think that that's kind of idiosyncratic, if we could expect more, if it's a broader reflection of some of the challenges that you're discussing here?
Well, I think, Leslie, you're seeing the big global automakers in fairly good shape. We just saw the results from Ford and GM. Obviously, they have fortress balance sheets, and they're producing a lot of free cash flow and profits. That being said, you're seeing the supply base under severe strain. And, when you look at just some of the challenges of the last couple of years, whether it was COVID, the semiconductor shortage, and, other issues thrown at the auto industry, the supply base, particularly the tier 2 through tier 4 suppliers, who are the smaller suppliers, are under a lot of stress. And that, to me, you've seen some of that with the bankruptcy of First Brands and some others. That's a bit of a canary in the coal mine. So I think the automakers are very focused on looking at their supply chain and understanding who's strong, who's weak, who do they want to deal with, who do they want to merge, so they have a strong supply base. But I think that's the soft spot in the auto industry right now, of course, depending upon consumer demand, which is holding up pretty well.
All right, very interesting. I'm just going to be blunt. Can we just take a quick second to actually let me share this again? This guy already won. Like, why? He's a former CEO. He retired. Why are you still in a suit, my guy? Like, just you already won. So I just don't understand it. Like, I'm trying to understand. Like, I'm not in a suit. Like, I'm at home. I'm not retired or anything like that, but we have 1 minute until the end of this week's market. Let me just pull up in the background. How are we looking on the SPY for this evening? Let me pull up the legends and see. This is my 24/7 dashboard. I don't know if I've ever shown this live on stream before. I'm working on something in the background. Hopefully you guys will enjoy it. But let's see how the markets are looking. So we're at almost at all-time highs. We did hit over 680 at one point or 6,800 on the S&P. So crazy times associated with that. IWM up over today. The Dow Jones Industrial, the Qs, everything looking like it is looking pretty good overall. We definitely can't complain. All right. We are 8, 7, 6, 5, 4, 3, 2, 1. Market is closed for the week, October 24th, 2025. Market won't open for another 65 hours and 30 minutes, believe it or not. Crazy. All right, so getting back to this, let's see how some of these things ended up. Let's look at Palantir. Palantir ended up at 184. Rocket Lab ended up $64, rebounding. At one point, it was back into the 50s earlier this week. We have iBit, which is a proxy for Bitcoin, hanging out at $62. Speaking of that, let me pull up Bitcoin in the background, and I'm curious how some of these things look. Actually, it's been a minute, if I don't say so myself, how things have actually shown up in terms of Bitcoin. Bitcoin at 110.5. Let's see how Ethereum looks. And Ethereum just below 4K. It's at 39.50. So interesting. Interesting afternoon with respect to the markets. My portfolio is a little bit all-time highs. Let me just make sure I'm not sharing. Okay, I'm not sharing. So my portfolio personally, where am I at? I am 2% from all-time highs. So that's pretty cool. Looking pretty good. In that respect, I'm going to steal something from Amit, and we'll do the 2025 stock draft. Sorry, once again, I'm running around like a crazy person. I have no idea what I'm doing. Like I said, this was just impromptu, so I appreciate you guys bearing with me. Hopefully you guys are still getting something out of this and enjoying. Hopefully we get Steve on, and maybe I'll send the link to a good friend of mine, Mr. Tevis, as well. I saw him in the chat, and I'd love to, now that the market is closed, maybe look at some of the tickers that you guys want to look at, answer some Q&A and chat with you guys, because not normally do I get the opportunity to chat with over 300 of you, unless I'm with Chris Patel on Cashflow Chronicles. So Fantasy Stock League, let's see. Some guy named Matt is still at the top of the leaderboard, 45%. So that's pretty cool. Curious as if this has particularly all the different stocks in here. We got Amit trailing in at 41%, though. That's pretty good. Tanner at 25, Chris at 10, and Steve, slow and steady, wins the race at 8.8. And I just want to say that I have a strong feeling I'm going to lose and end up being in the worst position out of everybody. There's a lot of time left. I think we started this in June, July timeframe, so we're only in October. There's a lot of time. Steve's got great companies. Chris, Tanner, Amit, they all have phenomenal companies in here. I've just been fortunate to pick some decent companies that have done really well recently. Overall, some of these picks like Rocket Lab, SoFi, Upselera, ASTS, they've all been on massive burns, and the ones that are really dragging me behind are EOG. EOG, I just anticipated was going to be a long-term oil play in case oil decided to go the other direction, which right now it's really hanging in the 60s, which I anticipated that was something that could happen, right? But I'm anticipating that in the next 18 to 24 months, we'll have some sort of reversal, but not after some sort of recession. So I don't know when the timing of that's going to be. So this is a gamble, particularly on that. And then Dutch Bros, that was a huge runner. The latter half of 2024 going into 26. Whoops. So curious to see how that ends up being going into 2026 overall. Steve, apparently you need work, my guy. Needs work. Steve, let's see what's dragging Steve down. He's got Micron. We'll talk about great companies. He's got Micron. He's got Broadcom. Let me just double check I'm sharing. Okay, good. He's got Micron, Broadcom, CrowdStrike, Microsoft. But the things that are dragging him down are MicroStrategy, HIMS, and Netflix. HIMS is below $50, eh? Interesting. And I actually don't think Netflix is horrible here. I'm not running out to jump and load up the truck or anything like that, but not horrible here. Let's look at the MITS portfolio. It's got Nebius. That's a good one. AMD. That talk about a pick. AMD is something that really upsets me, actually, because I really wanted to get involved in AMD, and I just never ended up pulling the trigger. and that was in the low 100s. And then, silly me. I mean, I remember watching Jeremy jump in, a few other people, and when I started seeing people actually get out, that's when I knew like this thing's actually going to take off. And I knew a lot of people personally that were just like, I'm done. I've lost money. I'm down 20%, and I'm just like, advanced money destroyers, what people were calling it. So yeah, at that point, wasn't surprised when I started to see some people actually start to dip out. And I was like, this is when I feel like it's going to be on a run. Let me make sure to send this to Senor Tevis. If he wants to join. For Tevis or Roy. Sending it to both Tevis or Roy. Overall. But yeah, great people. This stock draft thing has been a lot of fun. I just wish it was with real money. And Palantir, of course, doing a pretty good job in Amit's portfolio as well. Let's just see before we call it a day. Let me pull up my Webull and share my screen there. So I'll stop sharing that and instead share my Webull. And sorry, I got some sunflower seeds over here. Let me move that really quick. Let me share my screen, my window, and Webull desktop. Cool. And let's just run through some. So here's Bitcoin at 110. We got the Qs at 617. And this is showing the last 4 hours. So let's look at the last month or so. So pretty much since the end of September. So Bitcoin pretty much slightly down over the past month. The Qs slightly up, looking pretty good over the past month or so, going from the high 590s to 617. So looking healthy there. And then this is up, about 2% or so for the month of October so far. So let's hopefully have a good October, as they say. So we entered October at about 670. So hopefully we're able to kind of keep October alive. And so we'll see what happens with that. Rocket Lab, we are up for the month of October for sure. We entered in the 40s. So the fact that we hit $72, $73 at one point, and have now retraced, interesting to see where we're at. We're at $65 after hours. Palantir, this one's been rather flat the past month or two. That's fine with me. I'm still, for those of you guys that are following me, I started buying Palantir again. Was fortunate enough to go to their offices in September, and they showed us some stuff. That's all I can really say about that. And that stuff was mind-blowing. I was always impressed. That's why I bought Direct Listing Day, just over 5 years ago. And them showing me what they showed me, it just reiterated why I bought in the first place. The company will be the number one software company, in my opinion. Maybe not cloud or anything like that. They share their, they use existing cloud infrastructure, so they don't really have anything like that. So they use GCP and AWS and Azure and other things to kind of run their product through an instance on Google Chrome or whatever internet browser you want. But I prefer Google Chrome. But that being said, they don't provide their own. I think that they should. They have a lot of capital. I think they should potentially start their own cloud business. But hey, I think that would be honestly like something that's super useful, like a cloud business, particularly for and isolated for particular businesses. I think that they would pay a premium for that, right? Computing power that's specific to and cloud computing that's specific to specific places. So it's a lot more secure. It goes into what they're talking about, right? Always secure. If you're talking about AWS or something like that, might not be as secure. So you've got this on-premise sort of cloud computing. It might be, but I don't know anything when it comes to that stuff. They're the smart guys, and they'll know. Google up a little bit. We entered at 240 or so, 230, 243, and we're up at 260, believe it or not. Talk about one that I've been preaching about for quite some time. I was a buyer and had been a buyer for quite some time on this one. Was happy when it got to the 200s and was screaming, hey, I'm going to keep buying it. In the 140s. My biggest problem is I didn't buy more. That's always ends up being my problem for majority of things that I end up buying, is that I didn't end up buying more. Dutch Bros initiated buys back again on Dutch Bros. Let's take a quick look with this one, and we'll get into some of your questions. It peaked out at $74 in the last 3 months. At one point, it was over $80, I think, over the last year. It hit over $85 after some really good earnings as it started to show at the latter half of last year that they started to get to a cash flow break even. The company is profitable. It's not a pre-revenue company or anything like that, generating a lot of good money in terms of that. They're obviously in a growth mode, heading for 2,000 stores by 2029. Each store making about $2 million worth of annual unit volume. So that'll be a decent amount of revenue growth between now and then. And that's the hope, is that they're able to maintain their operating profit per store. And that's kind of the story associated with Dutch Bros. And if they can accomplish that, it's going to add to the bottom line and look really good. And what are they going to do? After you add so many stores, what are you going to start doing? You're probably going to start giving out a dividend and buybacks, but that's not what I want from them right now. I want them to keep building those stores because those stores are profitable. Amazon relatively flat. We came in at about 219. We're at 224, so up about $5 for the month. Apple, some ups, some downs, but we're slightly up. Back at all-time highs pretty much for this bad boy. Let's take a look at this chart, man, for the one last year. Yeah. Look at that. Finally back at all-time highs. 257. It took almost a whole year to get to all-time highs for this one. I just, Apple's not my biggest one. I'm not the biggest fan, but I say that, and I should eat my words on that because of not being able to buy it and or not buying it and obviously unfortunately losing money. This is SL Green. SL Green down to $51. Anybody that's following this one, I've been looking at some real estate plays, seeing potentially to get involved in those. Another one fan favorite of the group here. We got Venture Global closing at $9.50 for the week. Verizon closing below $40 for the week. So curious about that one. Webull, if you guys are following this one. This one closed at $11.50 for the week. We entered the month on Webull at over $14. So back down to buy range, in my opinion. And maybe on Cash Flow Chronicles, we'll talk about Webull on Tuesday. So fingers crossed associated with that. Firefly, for anybody that's following that one, hanging out at the $26 range and kind of hovering between $26 and $30. So there's that. We'll call it there for looking at tickers, unless anybody particularly wants to go into something. But we have something special. He's sitting in the dark. I'm worried about him. I don't know why he's sitting in the dark. Now he's playing with his hair. Senor Tevis.
Hey, what's up?
Good seeing you, brother. How are things?
Good to see you, man. I just finished work.
Is that where you're sitting feeling sorry for yourself in the dark? Or
actually, that reminds me there's something I still need to do. Yes, that is exactly why. It's Friday, end of day, and naturally we're sitting in the dark.
Yeah. Well, you got me. You keep me in the dark. I message you, and then for months, I'm just kidding.
That's a lie.
Good to see you, man.
I'm gonna leak our DMs. It's gonna be like, Matt, pay attention to me, and it's like scene.
Well, you have to blur out some stuff. Not everything's appropriate for public consumption. But yeah, man, good to see you. What flavor you got today?
I wanna address that comment. Tevis did not dye his hair. This is what my hair looks like when it's dark. But if I turn on the lights for you, I look old as fuck.
You get that salt and pepper. That silver fox. Oh, there he is. Oh, you're on mute. You muted yourself.
Yeah, exactly.
Yeah, that's silver fox.
Anyways,
What flavor are you sipping on, my man?
dude, they gave us the short end of the stick here in Canada, as always, because we used to get packs of 3 at Costco for Celsius, and they always came in, packs of 3 if you're buying in bulk. And it used to be the orange, the peach, and the tropic vibe, and they changed the orange, and they gave us this shitty Arctic vibe.
Yeah, I'm not a fan of the Arctic.
It's so bad, and I'm like, I hate half of this crate that comes in.
You know what's great about America?
Okay, starting at the Celsius and working our way down.
Yeah, starting at Celsius. We got great flavors like blue raspberry. Oh my god, look at this good-looking guy.
Hey guys,
Hey Roy, good to see you, brother.
good to see you too.
So yeah, for Celsius we get blue ras, which I think is a non-fizz. That's really good. And then one that I ordered, I'm having a blue monster myself.
This is my one a week, so
there you go.
One a week?
Yes.
Wow, that
Yeah.
is.
Roy doesn't need
Roy's
that
gonna
much.
live us all, bro.
Yeah, Roy's naturally.
Yeah. So I switched to tea. We have an electric kettle. We've had one forever, and yeah, it's actually really good when you buy decent tea, and you have the electric kettle, so you just turn it on. So, and I was drinking too many of these, so I'm like, hey, let me make it a special treat instead of every day.
Somebody said, "Do you Americans drink any water?"
What's that?
There's water in this, I'm pretty sure. So yeah, right there at the top, carbonated
Water mixed with freedom.
No, I mean, have you ever heard Ben Franklin? I think he said God's way to tell us that he loved us was inventing beer or something like that. I don't remember.
Wouldn't surprise me that he said that. Yeah.
Yeah. Interesting. Well, that and so another flavor that I hit the markets. Well, I don't know if it's new, but pink lemonade actually, which is actually phenomenal. So interesting. Yeah. What is water? Hot Sam changed his name to Solid Finance. I like that. That's fancy. Anything that you guys have been buying today or this week at all? I'm curious. Now that I have you on the Friday close, thank you and appreciate the impromptu. I know I wasn't expecting to go live, but I saw the opportunity and the community needs it. As you can tell, we have over 600 people hanging out. So
yeah. For me, just BMNR and more Ethereum and my DCA into Bitcoin. That's it.
Hot Tevis.
I didn't buy anything today. This week, I bought more Nebius at 105, and I bought more BMNR at whatever it was, 48 or something, yesterday. And I sold covered calls on BMNR, and I sold covered calls on Tesla, and I sold covered calls on Duolingo. And I think that's it.
Edwards London, thank you for the 20 gifted. Much appreciated, my man. Much appreciated. Interesting. So, Tevis, I don't know if you've had the opportunity to talk to this particular community. I know you have a lot of following on yours. You lightly put it that you have now surpassed me in YouTube followers the other day. So congratulations on that. Well deserved. You put way more effort into your YouTube channel than I do. So congratulations. And the hustle is definitely well noticed on my end. So hopefully the community notices it as well. Want to hear your thoughts on BMNR, because I think a lot of people, a lot of the community are still piling money into this thing and it's still relatively flat. I mean, what's the thesis? Is it going to be something that you hold into 26? Are you looking for a 20-30% pop and get out, or what's the thought?
I think for myself, I am split down the middle. Like there's yeah, exactly. We're getting bootleg twice. there's a portion that I definitely want to hold for longer because I think the sort of macro thesis of institutional adoption is still very much valid. Like we're seeing more volume flow into Ethereum. We're seeing more utility from Ethereum than we have with Bitcoin, and we're seeing more activity. Now, you could say, hey, Tevis, that's actually very seasonal because you're in this like Bitcoin or crypto bull market and money always flows from Bitcoin to ETH and alts. And it's just the natural part of the cycle. And you're attributing value where like it's just normal and you're attributing meaning to it. So that might be the case. And I think that BMNR is going to get a big bump in a couple of stages. Number one is when Ethereum gets a big bump. So if we see ETH at 5,000 plus, then I think you're going to see a good premium on BMNR. I think inherent to BMNR themselves, they're going to get a bump when they reach that 5% accumulation goal, which is going to, at this rate, going to be sometime in January is probably my guess. And then by that point, like they're going to stake. And as they stake, they lock up some of that supply. Like one of the biggest critiques of Ethereum is that it has an expanding supply and it's not truly like it defeats one of the core tenets of Bitcoin because it's anti-inflationary essentially. But then again, like Ethereum burns to mitigate that supply. So I think in order to be bullish on BMNR, I split it out into two camps. Like you got to be bullish on ETH in order to be bullish on BMNR. And depending on where you are on that spectrum of how bullish you are on ETH, and the BMNR is going to be a trade for you, you want to ride the momentum, or it's going to be something that's long-winded where you have to be willing to take the crypto winters along with it as a long-term investment. And now what I will say is that last thing, is BMNR is a levered bet, right? So if we do get a crypto winter with ETH and let's say it's 2026 or whatever, this thing goes to 100 or plus, and then we get crypto winter, BMNR is going to get hurt disproportionately just as it's going to get benefited disproportionately today. And so that's the thing where like I hold underlying ETH and I haven't really even accessed or seen that ETH in like years. It's just something that I passively hold for the long term because I'm bullish on the ecosystem, and same with Bitcoin. But do I want to be holding BMNR through a crypto winter, knowing the dynamic because it is a levered bet, it's going to get disproportionately hurt? Like I don't necessarily know. And so that's why in my mind it is split. Like I want to ride that momentum and I want to ride the sort of wave up because I think we're seeing a lot of exciting things. It's making me more bullish on Ethereum as well, where like I want to buy more underlying ETH. But at the same time, like I want to be careful to not get trapped in something 6 months down the line and I don't think crypto winter is going to come anytime soon. It's going to be maybe in 2026 at some point.
Roy, your thoughts?
Fairly similar. I'll point out just a few things as well. So technically, prior to 2022, they didn't have any burn in the system. That was one of those changes that there's a burn of gas or a burn of Ethereum every time that gas is used. And so you can see that the supply effectively has been flat. Now, some people said, oh, they can inflate anytime. They don't understand how consensus blockchain works. You can't just, Vitalik can't just come in and say, I'm going to do this. That doesn't happen. So I think that this part is overblown. I'll note also, so that the thesis is, like Tevis said, tied to Ethereum continuing to increase. The nature of stable coins, if you look at the actual network itself, most of the stablecoin market is on Ethereum. So you have over half, 162 billion. Most of that is United States dollars. The United States basically is saying, stablecoins, go for it. It helps us out tremendously. Companies as well. So we're going to continue to see that adoption climb. Most of that's going to be built in Ethereum. And so like the real question for Ethereum is, as there's continuing to be more and more congestion, what do? That's where layer 2s come in. That's also where sharding in the future, as far as a network upgrade comes in too. But as far as the way that the decentralized or the DATs work, if we look at the overall and we look at market data, we can see that this is a little bit counterintuitive, but people can say, oh, there's a lot of competition here. And actually competition for BMNR and also for MicroStrategy is a good thing, because in essence, that means more buyers for the underlying Bitcoin, or in this case, Ethereum. Now, also we can see that the trading volume here tends to aggregate into one main play for Bitcoin, and we're seeing that play out also for Ethereum, which is BMNR. SBET is maybe still it might, but like you can see their volume is so small down here. It's insignificant. So going back to just Ethereum only, here we go. You can see their strategy is actually working tremendously. BMNR continues to add all the way along the way. They continue to trade above MNAV. And usually that the leader, or the person that's getting the most inflows from institutions and also retail, and they benefit from Tom Lee from that, they are able to do this because they're able to sell their shares at a premium and buy undervalued Ethereum as well. Look at, in contrast with all these other plays, which basically they ran out of gas and they were like boats, it's just adrift waiting for the tide to go in or go out. And that never was really the case with BMNR. And so SBET here did break out of that recently, but they've got a lot of catch up and work to do if they want to catch up. So yeah, in essence, if crypto winter hits, BMNR will do very poorly. That's why I have a 2-year time frame on it. Crypto winter tends to not last that long. We usually get a blow off the top moment. I don't believe that we had that. We have had some cryptocurrencies move up, but usually you'll see the blow off the top Bitcoin, and then you'll see the alts as well, including Ethereum, go on a little bit of run too. So when we see that, I will take some profits. I won't take everything off the table. But yeah, we've not seen that. Could crypto winter hit early? Yeah. I mean, there's nothing technically stopping it, but I do think it'll hit probably next year. So
no, I'm very much in that same boat for both of you. I mean, I feel like we haven't hit that blow off top yet, and I do think that sometime in 26. But I'm kind of curious. There are some people though that maybe not necessarily as familiar with what crypto winter is, and this might not necessarily be the most optimal way to describe it, but there's a lot of different macro and micro things that go on in the cryptocurrency market, whether it's the halvings that happen, which is basically an increase in difficulty associated with Bitcoin. But because of the sorts of cycles that have kind of shown up with respect to sort of the Bitcoin market, it ends up kind of rippling out through the entire cryptocurrency market. And it's generally showed up in waves, and it's been referred to as crypto winter. And so you'll have pretty much everything going back for quite some time. And this chart even goes more so to the left if you had more time. But basically, what this is they use this rainbow to kind of signal, potential buy times and sell times if you're more of a trader. But really, it's just a range that Bitcoin generally trades in throughout the cycle between halvings. And so every 4 years, there's a halving. And so when that halving kind of occurs, generally speaking, 18 months to 24 months after that, there's a peak. And so what Roy is kind of talking about with respect to this blow off is, yes, we've had some decent run up, but we haven't had this big peak up yet, as we've kind of seen in the previous 3 cycles. The one that happened between 2014 and 2016 timeframe, and then the one that happened in, say, 2018, and then the one that happened in 2021. So we haven't really had that big blow off top yet. And some people are saying, well, maybe there won't be one because there's no, say, massive cut in interest rates or anything like that is kind of occurring just yet. In the previous time, it was kind of led by a massive cut in interest rates, and that obviously led to something. But we are going to start entering a rate cutting cycle, and so that in previous times has kind of foreshadowed a spike up. There obviously was the halving, which is increasing a difficulty. So generally, some of that excess supply takes some time to kind of get pulled up, and then that just means that less and less it gets more scarce in terms of the amount of reward that you get every time you solve a Bitcoin block in the blockchain. So it just makes it a little bit more difficult, and obviously the scarcity increases, more demand associated with everything, less supply. Obviously, supply demand drives up price overall. But that ripples throughout the entirety of the market. So generally speaking, ripples out through Ethereum, it ripples out through Solana and many other cryptocurrencies. So for anybody that's interested, that's generally speaking what we mean by crypto winter. And so what I think, and I think Roy said this as well, and correct me if I'm wrong, Roy, because this was just my interpretation. I believe there's going to be a 20-30% uplift. I don't know what Roy's thoughts are on the pop-up, but he also agrees there's going to be some sort of pop-up. And I believe in the second half of 2026, we'll start to see it after that pop-up come back down. And so for me, and then I want to turn it back to Roy to kind of rebuttal what I just said or add to it. And same thing with you, Tevis. My process is I'm not necessarily adding a lot of money into specific stocks or anything like that. I'm just doing my dollar cost averaging that I do for Ethereum and Bitcoin. And what I'm doing right now is analyzing the companies that are doing well. The Robinhoods, the Coinbases of the world, Kraken's on the private market, BMNR is something I'm keeping track of, MicroStrategy. So when we do get to that place of crypto winter next year, when things are maybe half or even a third of their price, I'm able to pick them up at a substantial discount. And hopefully then, once we get into the 2028 plus time frame, and hopefully the next halving cycle and next crypto summer, I guess maybe you could call it, then yeah, hopefully I'll be able to ride that out and maybe take some profits.
Yeah, maybe I can just add a little color to that, and then I want to let Roy go. But so a lot of this is baked into the cycle because it all runs on Bitcoin. Like Bitcoin is the canary in the coal mine, let's say, for all of these other alts. And Bitcoin has a halving, which is essentially baked into the thesis. It's hard coded, whereby the new supply entering the market drops every 4 years. It's associated to the blocks that are mined. So generally, it's every 4 years, and Bitcoin runs into that event. There's a lot of anticipation into that event because of the supply and demand, which is sort of one of the core tenets of why people buy Bitcoin as a hard currency in the first place. And what happens is the crypto winter then happens after the halving event as a result of a mixture of inherent and macro factors. So the inherent factors are stuff like the fact that it's like it becomes a sell the news event, and then macro factors is that the market usually goes risk off with regards to liquidity, depending on what inflation is doing, what the Fed is doing with rates. It can make other asset classes more appealing, and then typically, and we've had this periodically, it's marked by so what Roy was saying, the blow off top event, it's marked by some high profile collapses. I remember we had FTX in 2022. You had, Mount Gox in 2014. You had the Terra Luna crash. You had all of these big sort of scandals essentially with regards to these projects or exchanges. You can also have macro factors. I remember in 2018, China did the mining ban, and that sort of sparked a downturn in Bitcoin in general. And so it's really a matter of when the market as a whole goes risk on and risk off. And that's also really linked to just equities in general. Right now, we're in a risk on environment, and I don't think we're really going to get crypto winter where you have a drying up of liquidity and a drying up of excitement when you're in a risk on environment in the market, right? And so I think that, end of 2026 is more realistic for us to have something like that because we had the halving. And now that Bitcoin is sort of reaching broad adoption from an institutional demand point of view as well, and from geopolitics, from entire nation states accumulating Bitcoin for their treasuries, it sort of changes the dynamics of the game because Bitcoin used to be predominantly retail investors that were buying this. And so those cycles were a really big shock to the system whenever they happen in terms of what happens following these cycles. Whereas now you just have massive demand that's far outstripping the supply. And you're still going to have these shocks to the system, but to a much lesser degree because you have such volume flowing into the system in general.
Yeah, and along with that, basically you have a tamer Bitcoin. So you'll have fewer like 10% up or down moves each year as time goes on. And crypto winter probably will be more shallow as time goes on. We've seen that. I think also the upside too is a little bit more shallow, but it also like elongates the cycle. So everybody talks about a 4-year cycle as far as crypto winter or crypto summer. That we're a little bit past that, and so I think maybe the second half of 2026 is maybe when we start seeing it. It could be a little bit later than that too. There's nothing stopping it technically now, but I think that those that are believing that there's going to be no crypto winter are just as wrong as those that are on the other side of this, where they're like, crypto winter is going to happen at any point. We're not going to get a blow off the top rally. Both would be weird. So yeah, I think Tom Lee's targets as far as Ethereum are probably pretty aggressive, but I wouldn't be surprised to see like a blow off the top where we see Bitcoin moving up, multiple weeks, very, very strong increases to something like 175,000. About at that point is when my actual Bitcoin holdings, I'm not going to touch. I'll just be like, what, can go up and down, do whatever. I'm just doing the DCA thing because Matt Money gave me financial advice to do that. And Ethereum likewise, but that's when I'll start to deleverage some of my BMNR holdings, which a lot of that's in the Swing platform. And I'll be public with that too. And also we'll probably take a little bit off the top from some other crypto exposed plays, which means Robinhood for me. So.
Yeah, and look, I know we sort of all DCA into crypto. You guys more so than me, but I have bought crypto this year. I bought some Ethereum last month. What I'll say is that, like, for people watching that might not be as crypto literate, let's say, or crypto fanatic, these things are patterns that you see in the market that are reinforced over time. But at the same time, it's similar to equity markets. Like, I think if you're long-term bullish on a company, you're not going to wait for it to hit this imaginary price, or because like, oh, we're seeing that a recession is going to be around the corner. Let me just sit on cash for a while. Like, it's better to be in the market for a longer period of time than trying to time the dips, right? Like, I saw people, Nebius fell from like 140 to 100, and then people came out of the woodwork and they're like, oh, I'm actually waiting for $30. And I was like, well, you're an idiot. Like, you're not going to get that because you're just like not. Like, I would love to buy it at 30, just as I'm sure we would all love to buy several of all of our stocks in the single digits. But at the end of the day, the adoption continues along, and you're going to get cycles around that. And so my point is like, if you're looking into buying Ethereum today, crypto winter really shouldn't be something that puts you off from buying it if you are in fact bullish on the long-term thesis with regards to the ecosystem. Crypto winter should be even an incentive for you to add more, but it's not a deterrent to buy today.
Mm-hmm. No, I think that's wise. I mean, maybe moving away from crypto specifically, just in general, I think that's a wise statement. So, for example, people might be sitting here being like, Matt, you're still buying something like Rocket Lab, you're still buying something like Palantir, even here. And the way I look at it almost is like, well, I have certain shares of that for Rocket Lab, for example, $3, $4 range. And so if you think about it, it's like, if I'm buying here in the 60s, technically, if you even out, it's like, well, I'm kind of offsetting it like as if I'm buying it in the 30s, right? Because you even out the cost basis between the two. And some of those shares then are kind of, so it's like, if I could buy Rocket Lab in the 30s, I would definitely love that. Now, when you have the ability, sometimes it's more about just getting as many shares of some of these companies as you can, because eventually they're going to continue growing in the long run. And I'm very confident that Rocket Lab will have a pullback into the 40s, potentially even the high 30s again at one point. And I hope I have the capital at that point to be able to add a substantial amount, but I can't guarantee that to happen. And so In the meantime, I just want to make sure that I guarantee as many shares as I can. And that's a mistake that I made with Palantir. And that's why I started buying Palantir again, even in the $400 billion range. And the thought process is eventually it'll be a $1.5 trillion company. They're going to continue to buy back stock. And while the buybacks right now are small, they'll continue to grow. And the company's just on a massive wavelength. And to me now, it's less about when am I taking my profit, moving to cash, and hitting the beach. It's these stocks are going to be something that I probably hold forever. And if I ever need money, I'm just going to borrow against it. And people are probably like, Matt, you're an idiot. Like, that doesn't make any sense. It's like, I've been looking, like, maybe this is a really wild approach to kind of take. I've been thinking, like, okay, all these banks are sending me things in the mail. SoFi, Wells Fargo, JP Morgan. They're like, hey, we'll give you a personal loan at 9%. And I'm like, dude, Robinhood wants to give me a personal loan, and I don't have to go through some sort of background check and how's my credit and everything. It's like I can just borrow whenever the hell I want for 4.5%. So it's like, why would I ever again need to sell it to take money? But anyway, just to
it's really interesting, Matt, because like you have alternate options. Like you can just take out a margin loan if you really wanted to. And I don't know what the math's at, but you could probably, depending on the size of your account, negotiate down a rate that's way more favorable than, absolutely way more favorable than a freaking personal loan, but then even like a mortgage, even depending on your credit score or whatnot. We had a broker here in Canada that they just had their product day this week. And they're like the Robinhood equivalent in Canada, obviously not with all the bells and whistles, but like they're the leading broker, and they're about a $6 billion company, privately held, Series E or something like this. And they just crossed 100 billion assets under management. Anyways, so they did their product event. I tuned in. One of the things that they launched was you can now, as a regular retail person, take out loans against your retirement accounts, because your retirement accounts, you can't, pull that out in the short term, and you can take out loans against it. And the way that they framed it was, obviously you're going to negotiate, like you're going to have a similar to margin, right? You're not going to YOLO lever 2x your entire portfolio, but you're going to take out a percentage of it. The way that they framed it, and I thought was really interesting, was you could have the ability to essentially take out a loan for what your deposit max is for that year. So let's say I have $200,000 portfolio and it's a retirement account, and because it's tax havened, I only can contribute 20 grand a year. Now, instead of me trickling in that money over the months as I get paid, I can just take out a loan for 20 grand on Jan 1st, be in the market that entire time, and then pay back that loan over the course of the year. And the collateral is my assets, and my assets are going to be there for years to come. And so I just thought that was a super interesting concept, because I have friends that do like private wealth management and private banking, and it's just like products that you've never even heard about, but they get rates that you've also never even heard about, because they have 5, 6, 10 million in the bank, and they get all of this preferential treatment. And now a lot of these new brokers are democratizing that to the degree where even if your account is 100K, you can only borrow 10, but like that's an option you didn't have in the past.
Mm-hmm. Yeah, and I think, and I want to get Roy's thoughts on this too. I think a lot of people are sitting here trying to say, oh, well, why don't you just sell? Like if you want, say you had $1 million in SoFi and you're sitting on, the $700,000 in capital gains because you rode it from $7 to 28, right? And you pretty much 4x'd your money, and you went from 250 to $1 million or whatever that number is. You might be sitting there like, well, yeah, sell it, put it in cash, and then take whatever you need and then buy it back. And then, hopefully at the point which you buy it back, you're able to buy it back for, say, $25. You'll be able to increase your share count. But I don't think, unless you're having it in a tax advantaged account, I don't think people are truly doing the math on that. And specifically in a place like Canada, where unfortunately you get taxed more than even in the United States, it's like if you were to take that 21%, $21 capital appreciation that you got and have to pay taxes on that, you're going to have to pay $6 in taxes. So you can't just buy back at $25, right? You have to buy back in the low 20s before you even break even on the amount, because you have to pay taxes, right? Just on that $21 gain, you have to pay $6 in taxes. And I don't think people are fully equating that. So if you sold it at 28, now you have to buy below $22 before you even hit break even on being able to, say, buy back in. And I think a lot of people aren't doing that, and they're putting themselves in a world of hurt because they say, oh, well, let me just sell it today and I'll buy it back tomorrow at 5% cheaper. And I don't think they're fully thinking that through. So I hope that people kind of understand that. So for me, for example, people are probably sitting there like, Matt, why don't you just sell Rocket Lab? Why don't you sell Palantir? It's like, if I just need 25 grand, like, why would I sell it? Like, why would I sell Palantir if I could just borrow against it for a couple months and put it back when I don't need it anymore, or put it back over time? But of course, if you have it in a tax advantage account, it's very different.
Yeah, tax advantage, you can get in and out, and you just like, I'll oftentimes do that with some of my positions where I wouldn't do that otherwise, where I'm like, okay, I need to round out a trade that I'm doing, so I'll sell a few shares or something just to do that, buy it back the next week or whatever. And in my actual account, I'm like, nope, I don't want to mess up. I don't want to get in the short-term capital gains tax stuff, any of that, and wash sell rules. So we'll just keep it simple. It kind of tangential to what you guys said. One thing that's interesting as rates fall, of course, lending rates are falling as well for brokerages. And so it's something to keep an eye on. There was a little over a year ago, I went to my first Robinhood event that I went to, and there was a guy that owned a lumber mill. And I asked, we started talking, and I asked basically what type of investor he was. And he didn't strike me as a high risk trader or anything, and he wasn't, but he had taken on a bunch of margin. And the reason why is he saw an opportunity that there was a spread between the margin rate that Robinhood offered and the yield rate on some attractive dividend plays that he had. So, right now we're looking at, for somebody just using a little bit of margin, which I don't, other than the 1,000 free that they give you on Robinhood. But I'll admit that it's tempting at a certain point. But, if you're convicted strongly that Verizon's going to be great under Dan Schulman, be careful with that, by the way. That's a 7.11% yield. Or if you're like, hey, JEPQ is over 10% yield. Those are higher dividends. You always have to make sure that it is something where the dividend's not going to go away or be reduced like EPS. But I mean, that's attractive. And I think that there will be some rotation as yield opportunities leave other sectors for people to go after some of those maybe forgotten stocks that have or dividend kinks. But yeah, it's not for a lot of companies that I hold. I'm the same way with you, Matt. Is like I had too much concentration in Palantir, so I had to sell. I felt, just as far as like mental peace, I had to take some gains along the way. I sold more than I intended to, just because some covered calls got underwater. So I'm doing what you're doing and just slow DCA. I don't think I'll regret that over the long term. Short term, yeah, maybe. But as far as most of the rest of my stuff, the way I approach very undervalued plays is I'll buy some leaps and I'll buy some shares. Those shares I don't plan to sell until I need them. Or if there's an opportunity out there and I need some money, then I can make a move. But otherwise, that's what the leaps are for. It's really just to lock into some gains and keep money moving. So
I wonder, and this is just me thinking out loud, but I wonder if there's a way to arb your margin allowance using options. Like, say, for example, I take out, a position on margin, then I have to pay the margin back. But if I sell covered calls that are way more aggressive from a percentage perspective, that are, let's say, a year out, then I can have enough money to essentially handle the margin requirement. Like, I'm just thinking out loud whether there's a way that
you can do that with puts already, right?
What do you mean?
You don't actually. So, for example, like, let's just say you have $1 million portfolio. You don't have to have $1 million in cash. Like, let's say it's all invested. They'll give you, let's just say, up to 50% of that value in terms of margin availability. You don't have to have $500,000 in cash. So you could just write the puts against the margin value of the portfolio, and it's not going to charge you any interest rate until you actually get put those shares. And so you're pretty much making infinite money on your return, right? Because you can pretty much write a cash secured put, but it's not covered by any cash. It's just covered by the cash value of your portfolio.
And then let's say I do that, right?
Mhm.
I sell cash secured puts that's 3 months out or whatever, and my margin is my collateral. Is there a way that I can then hedge that? So I'm trying to arbitrage.
It doesn't pull out any margin though. You only get charged
in case I get hit. I mean.
Oh, okay. Yeah.
Right. So like, okay, I want to sell a cash secured put on Robinhood. Robinhood's at 140, and I say, okay, by January 1st or whenever it is, January 2nd, I'm selling cash secured puts for 100 on Robinhood, and I'm going to get paid some money right now. My margin is not hit, but what I'm saying is, if that date comes and I do get hit and I do decide not to roll, that's when I'm going to get the margin hit. Is there a way to hedge that, or I guess just roll it out?
Yeah. Hedge it, meaning I'm trying to understand what you mean by hedge.
The only thing that comes to mind when you're saying hedging is maybe predictions market. If you're like heavily invested in SoFi and you're doing cash secured puts in SoFi, on Polymarket you can bet on EPS beats or misses. Of course, everybody's skewed towards beats. You're like, you know what? I'll take a little bit of money. That would be my gains. Otherwise, from selling the cash secured puts, put it on the prediction side of misses, which would be shocking, but also give you a pretty dramatic return and maybe hedge some of the damage. But I think it's sometimes you can get pretty complicated pretty fast, and it usually makes sense in my mind. Where I can stay simplified, I'll just stay simplified.
Yeah, and it's not to say that you have to do these things, right? I think there's opportunities for things, and just like with me saying I'm not selling X, Y, and Z, do your own. It's your portfolio. Do what works for you. If you'd rather just take money off the table and transition it to something safer, like say you made it in a crypto stock or made it in a nuclear stock or a quantum stock, and you're like, I want to get out. I just want to put it in the S&P and just, hold off on anything risky. Please do that, right? Do what you think is best for you. I'm just doing what I think is okay for me, and I'm willing to take on the risk of some of these single assets. But that's me.
Matty, what are you buying? What did you buy this week?
I actually sold out of SoFi. Not that I dislike SoFi. I think SoFi is great. And I don't like to make a lot of ins and out, but SoFi has always just been one that's on the peripheral of my positions. And I try to keep a very small number of total positions. And unfortunately, SoFi just ends up being that one where it kind of keeps coming in and out of I do want to own it and I don't want to own it. And so to me, I've been on this big kick as of late. Sorry if this is like a broken record for people, but as of late, I've been on this big kick of just trying to get to 1,000 shares of Amazon. And because Amazon will be a $10 trillion company. And so if you do some quick mathematics, there's 10.6 billion shares of Amazon outstanding. And it's currently a $2.2 trillion company. So if you think about it in that perspective, if you were to buy 1,000 shares today at $220, $230 a share, by the time it gets to 1,000, it'll be $1 million position. And so you could just guarantee it almost, right? By no means do I think that Amazon will not be a $10 trillion company within the next 10 years, I'd say.
Look at these guys.
Fucking guy. He heard that Matt sold SoFi to buy Amazon. He just materialized.
He just magically appeared, and he agrees with what I did.
Well, no, I'm just, Matt was texting me, and I'm like, I don't have a link. And then I'm like, maybe he sent it on freaking X. And
that's what you do to me. Don't act like I'm playing different cards here, Steven.
No, I wasn't putting two and two together.
I like the quarter zip / the vest.
It wasn't cold enough for a jacket, and it wasn't warm enough just to wear short sleeves walking around the city.
Dude, Steve's rolled in here like he works for SoFi's executive team. And he's like, you sold with the fit that you have right now. You look
What are you
gorgeous.
talking about?
We
You
work
look
for
like a
Steve.
banker.
This is how I dress.
No, and it looks good, man. You dress like you're wealthy.
I mean,
He is-
I wouldn't
he
go
is
that
wealthy.
Yeah.
So Matt, on that prediction, is that mostly from operation gains as far as efficiency from AI and robotics, if they continue that and they're reducing by percent of their revenue their CapEx spend, or is that just a boom in e-commerce, the economy overall, and Amazon's well positioned with that, or what are, and of course inflation, but what are the factors there? Like,
So yes, many things, and I know Steve can go on for like 3 hours about this. So I'll give my thoughts, and then Steve will correct me because he knows the numbers way better than I do, and I welcome that. But Steve and I are both on this opinion. Amazon will be the first $1 trillion revenue company, and that'll happen. For me, it's hard to say. I noticed it 2 or 3 years ago when I saw, holy crap, they're already at $500 billion in revenue and they're not slowing down. And I was like, at what point is this going to continue? And I started doing the math, and I'm looking at the trajectory, and I'm like, this is going to $1 trillion, and it's not going to stop. And so that's evident. And so even if you have that at a 10% margin for that particular business, I mean, that's easily $100 billion. But the margins are going to be better than that for a lot of the business because you have AWS, and so AWS is going to be way north of 10%. It's probably going to be in the 30%, if not more, operating margin. So that's going to be a whole $1 trillion business on its own if it isn't already. So there's that piece. I don't think that at the moment we get the margins from Europe. Europe, I still think is just hitting its sort of break-even point. So there's that, and then there is a lot of automation that needs to flow through. So I think the easiest 3 ways that kind of comes to say is there's lots of revenue growth to come. AWS is far from done, and lots of automation will increase the revenue. The bottom line margins. And when you think about bottom line margins on $1 trillion worth of sales, every 1 percentage point is $10 billion of net income. And then you multiply that by 20 to 25x. That is a $200 to $250 billion market cap. So of efficiency gain, right? That is where you're going to start to get that. Plus, eventually, you're going to get buybacks as well. Not yet, because I think that at the moment they still have a lot of growing to do and a lot of infrastructure to build. Not maybe in the U.S. per se, but in Europe and maybe South America and many other areas that they're trying to expand. But there's a lot of efficiency still to be made, and I'm curious what Steve's thoughts are.
So yeah, look, Matt knows that I agree with him on that. I'll expand a little bit deeper. I said it maybe 2 months ago. I think that Amazon has the potential to be the first $10 trillion company market cap over the next 3 to 5 years. That may not happen. Take it with a grain of salt, but
3 to 5.
maybe.
You're an animal, Steven. I love it.
Maybe.
5x in 3 years on Amazon, Steve?
No way.
Maybe. We'll see.
way.
Maybe it takes a little longer, but here, roll with me, right? 2029 is 3.5 years away. Less than 3.5 years away at this point. 3.25 years away. That is the year that they're projected to become a $1 trillion revenue company. They spend $160 billion on their selling, general, and administrative costs. Their total operating expenses is $256 billion because they spend $95 billion on R&D. We know from the New York Times article that they are expected to get rid of or replace 600,000 jobs. And I've been saying that they're going to have tremendous efficiency gain through robotics and AI internally. So when I think about it, $1 trillion revenue company in 2029, and it just goes up from there year over year. They're an 11.8% operating margin now. They could theoretically get to a 20% operating margin through making their general administrative expenses decline. They don't even need
they're currently hold on, just one point.
Yep.
They're currently trading for a 3.5 price to sales. What makes you think that when they hit 1 trillion in revenue that they're going to be having a higher price to sales multiple? I know the market doesn't view them.
I'm getting there.
Cool.
I'm getting there. That's the next point. So if they can go from an 11.8% margin to a 20 to 25%, call it, we're going to say 20 for now, but higher hopes in 2029, that means that their operating profit or operating income, whatever term you want to use, would be $200 billion in 2029. And then that would continuously go up. They're not even buying back shares yet. And if you get to a point over the next 3 years where data center build out goes into maintenance mode and there's no additional CapEx and it's just straight plateau where it's just ripping and replacing and not expanding, you could see them increase profitability even more. And if they implement a very big buyback program in 3 years from now, because they're going from 78 billion to 200 billion in operating income, you could see a 50 to 100 billion dollar buyback program that's in the street eat it up. And then over the next 2 to 3 years after that, sequentially increase a little bit. They have the lowest operating margin out of any Mag 7 stock. I mean, spectacular 6 because I don't include Tesla. But my whole premise is if they get up to 20 to 25% operating and they're the first $1 trillion company, they keep going, they're going to harness so much profitability. And out of all the spectacular 6, they have the most to gain from internal efficiency and robotics because of how big their administrative costs are. This is a company that can reinvent itself without actually adding a single dollar of revenue. And then when they do, each additional dollar of revenue is even more profitability. So I think it's the easiest one out of the spectacular 6 to own long-term at this point. And when I say long-term, 5 to 10 years.
Yeah, I think you're overly ambitious as far as your timeline there. I would be and think it's very, very, sorry, my Alexa's going off. Okay, I stopped it.
He said, Alexa, shut up.
I did.
She was going off because of Steve's Amazon bull thesis. That's why.
Yeah.
She was fired up.
So in essence, I think that the CapEx expenditure is going to go up tremendously, not plateau, basically through 2030. It has to do what they're doing with robotics, to do what they're doing with the tritium chips. They call it something different. Tensor, I can't remember it. And also what they're doing with AWS data center. Like it just, there's so much need for that to continue to ramp. I don't think we'll hear anything different on earnings as well to indicate otherwise. Now, further out, like what Matt said, could they, 5x essentially in 10 years? More aggressive than I would put them. I'm more like maybe a 2.5 to 3x, which is still like really, I don't think you'll be crying if you have that. It's an attractive valuation. I just always see more attractive plays. But yeah, Steve, I think you're way too ambitious on what they're going to do over the next 3 years. But
you don't think that they can get to a 20% margin?
Not that quickly, no.
We'll see. I mean, they're going to get rid of 600,000 jobs and replace robotics and AI. So
the initial expenditures for that, the robots themselves and the integration and setting everything up isn't free. So there'll be an acceleration there on the CapEx side, and that's going to be a multiple year thing.
I mean, we'll see about that. I mean, they're already spending over $100 billion on CapEx. And keep in mind, they have overspent for so long against everybody else, and the majority of that has been the logistical network, including robotics. At some point, they're not going to be spending or growing their CapEx at the rate that they are. And even if they are growing their CapEx, that's not stopping their operating margins from increasing. And that's also not stopping their cash from operations from growing. So look, my whole thesis is they need to get to 20% margin, which maybe it happens, maybe it doesn't, but they got a pretty good chance through automation, because let's call it what it is. It's not innovation, it's automation. And after they put all the robotics in place, that's all depreciated assets. They get to depreciate off the books. And they will be a fully optimized warehouse business, and their costs are going to come down. They need to implement a big buyback program too.
And
So
to that last point, I think they can artificially pump their stock quite a bit
100%.
if they just, at whatever point between now and the next 10 years, redirect that entire CapEx spend to a buyback program. And it's like, okay, great. You just come out with $100 billion plus buyback program, like at the extreme end, I'm saying. Right? Well, you're going to be buying back a huge port. And then, like, I know what you're going to say. Well, it's not working for PayPal. But you get my point, though. They're going to just buy back a whole bunch of stock. Apple's been doing it. It's been working out well for the last decade for them.
Amazon's not PayPal. People care about Amazon. Nobody cares about PayPal.
I care about PayPal.
Yeah, but you're not most
nobody.
people. I used to care about PayPal, but it's not worth caring about anymore.
So the other thing I'm seeing with Amazon further out, so not shorter term, like longer term, which isn't, I think, not a reason. It's not a reason to not invest. It's just something that scratches the back of my mind. If they do what they're doing with robotics, and it ends up displacing and replacing a lot of jobs, including future jobs, it wouldn't shock me in the next administration that there is some pushback for that on the regulatory side, whether that's massively taxing upfront the robotics, whether there's some sort of weird payroll tax on robots. If that doesn't happen, it'll take a while, but it might be that just consumers don't have cash to actually make purchases. And as a result, that really hurts Amazon. That'll take a while to play out, but like, unless you're assuming that just Amazon is going to move into robotics and displace a lot of other jobs, which I don't think that you guys are saying. So further out, I'm very curious how that plays out, but it's factored into me not seeing like a 5x increase, because you're either going to be squeezing consumers so that a bunch of people are out of jobs and are on food stamps and they're not going to be on Amazon, or you're going to have to do some sort of weird taxation type of stuff on robots, which is going to be not bearish Amazon, but it'll still be net benefit to them with the robots, but not as much as they'd have otherwise.
I mean, we could go down that rabbit hole if you want. I mean, robotics and AI is going to be very difficult for the job market over the next 5 to 10 years.
Which is bad for Amazon.
It's bad. No, it's bad for people.
No,
it's not bad for
Amazon. It's bad for Amazon's current employees, which are not going to have a job anymore.
Yeah. It's not bad Amazon. It's bad for regular people.
Look, I think just to bring this back is, I think all four of us are bullish Amazon. I mean, I think we're all, except for Roy, maybe we're all holders of Amazon, and we all think that Amazon's going to go up. We're just debating the varying degrees and the velocity at which it goes up. Matt's original comment was he sold SoFi in pursuit of his Amazon accumulation target. Maybe not like, hey, SoFi for Amazon straight up, but like he's decelerating on one, or has, and he's accelerating on the other. And so I guess I want to catch the other side of that, because like I think that's a better, and maybe it's not a debate we want to have, but like I think that's a more interesting conversation around like, you know, why would you sell? So like I think we all agree Amazon's great, but SoFi is also great.
I'll tell you something you're not going to want to hear.
Please.
I said this to somebody the other day, as in this week. I would seriously consider exiting SoFi around 35 or 40.
Why?
I don't, because I think Hood's personal opinion, right? I don't have any knowledge. I don't have a crystal ball, but I could see Hood declining. And I don't think SoFi is getting to 45 for June. I think 35 will be the tranche. And at that point, I would be up a percentage that I would feel good about getting out on. And I would redeploy that into some other stuff, potentially.
By getting out, exit completely or reduce size?
50% or more.
Okay. So probably not full exit, just take
probably not, because I do like Noto and I do like the company, but at the same time, I think that at that point, the easy money will have been made. And I don't think that it has the potential to do what Robinhood did. We're getting to 100 anytime soon.
I think that like I said, I like SoFi, and it's not because I dislike SoFi that I sold. It's because I like to keep my portfolio very consolidated and concentrated into select amount of numbers. If I held 25 stocks, SoFi would be in there, and so same thing with Nubank. It's just unfortunate that my mind works on hyper focusing, and it's been very successful for me over the past several years. And because of that, it's just the way that I've been operating. And to be fair, and another thing that I like to look at is SoFi is great. It's a great bank, and I think it will eventually hit $100 billion market cap. That's for certain. But do I want to be in a bank that maybe isn't necessarily the top bank? You know, would I rather be in something it's number one in e-commerce and number two in cloud, if not number one in cloud? If you think about actual terms of market share ownership, maybe not revenue, but actual market share ownership, you could say that they're the top contender and market share owner in both of those categories. And that is something that I can guarantee is going to continue to happen.
Add one more vertical, number 3 in advertising.
Good point. So yeah, there's that. So sorry, I didn't mean to like stir up a whole topic of conversation there, but yeah, I think that's currently my focus position right now is Amazon, and I did buy some more Next Decade, some Venture Global. Last week I did my normal typical buys with Ethereum, Bitcoin. Did I do anything else? Might have been in. I think with some of the covered calls that I was able to write, I might have doubled down on some of the oil plays when the oil went below 60. Not doubled down, but added a little bit. Because it's relatively small drip that I'm adding to those. And when you get to the below 60, it's nice to be able to add a little bit more. So
yeah, I guess I see SoFi a little bit differently than you guys do. Not probably Tevis, but I don't think that they're going to do what Robinhood did of like from $8 to 150, whatever it is today. But that doesn't mean it's not going to have a tremendous increase, and so it wouldn't shock me. So it requires macro to stay favorable, and it's been very favorable to banks. We've seen regulations shift from being oppressive towards banks to actually being so beneficial that weird things are happening with companies that never wanted a banking charter, never wanted a banking license. They're asking to do that, including Mr. Beast doing the same. And so like they're all seeing the same thing, that there's this tremendous boom in banking. SoFi is well positioned to benefit from that. Of course, the wealth transfer, which is a larger thing. They're not the only ones that are disrupting the orthodoxy, but those tailwinds are going to be something to pay attention to over the next few years. We'll see what they do for earnings, but I have them just under 40% year-over-year revenue growth, 39.9% this quarter, which is ridiculous, tremendous, and really without the help of the tech platform at all. And really, what I think over the next, this quarter, and then really quarter 4 and quarter 1 as well, it's going to be very interesting to pay attention to the cadence of product launch. The migration to the tech platform should be complete. The loan platform business is still within its first year, and there's so many more products that they could spin off of that. We're seeing from other lenders like Lending Club tremendous demand into almost over 95% chance of 2 more rate cuts this year, and more rate cuts expected next year as well. Also at the same time as monetary policy tends to soften. So there's so many tailwinds. I think that this is far too early to even think about taking gains on SoFi. That's at least where I'm at personally. Now I've taken some on options just because that's why I do options, is it makes me take gains. But as far as any stock or anything like that, if it was not my second largest position, I'd be adding SoFi here, not selling.
Yeah, I mean, look, I can understand everything that's been said. I don't necessarily everybody makes decisions that are based on their own portfolio. Like, I get what Matt's saying, because I also have positions where it's a small percentage of my portfolio, and as a result, I don't dedicate a lot of brain space to that position, nor do I follow it like that heavily. And then I get what Steve's saying, like, hey, if you're going to have a multi-bagger and you're going to take profits, like, go ahead if you think there's better opportunities. Fundamentally, like, it's a growing business. It's executing, and I don't think anybody disagrees with that. So it's different, right? It's like, Matt, Palantir is your number one stock right now that you're holding?
Rocket Lab now.
So yeah. So it's like asking Matt, like, hey, would he sell Rocket Lab? Like, well, that's the one that he knows the most about, that and Palantir, and then SoFi was the least. And like, for me, I think my smallest position in my portfolio right now is maybe Robinhood. And I don't know nearly as much about Robinhood as Roy, Tanner, or Amit. Still holding it. I think it's still going to do well. I think it's still growing. But at the same time, if you asked me, like, gun to my head, would I pick one? I would probably pick SoFi over Robinhood, even though like it might underperform just because I know it's so much better and like it's a comfort thing. Like I can sleep easier at night. So like I get that brain share and portfolio wallet share association is a weird relationship to sort of break.
Sam, what do you think about this whole Amazon thing?
Dude, I was trying to set up my Bluetooth for a little bit, but I couldn't get it done. What's going on, guys? Hello, Tevis.
Good.
Hello, Roy.
Glad you're here, man. I like the name change on YouTube.
Actually, that was always the name. I just switched to the channel that I always stream off of versus my kid's account.
Very good. Very good.
I don't even know like where were we on because I missed like the last few minutes.
Just what I sold SoFi for Amazon. Did you hear that piece?
No, I did not.
No.
I mean, it's probably in the short term. I mean, who knows where these small caps go up and down. Probably less risk for Amazon in the short term. I mean, long term, you probably have a much higher trajectory for Amazon. I mean, but who really knows? I mean, obviously they're cutting rates. I feel like the market already priced it in. We got like a 95% chance of getting a rate cut for the next meeting. And I think it's like around 90%, 92% for 2 rate cuts in the meeting after that. So far, the Fed is projecting around like 3% by the end of 2026. So like we're kind of seeing the end of the rate cut cycle around like 2.8 to 3%. So then that would be like another 2 more rate cuts by the end of 2026. And when you really think about it, I'd be like,
can I share my screen on that?
Yeah, go for it.
So this is call sheet. This is the number of rate cuts. And like you can see the 3 rate cuts option has skyrocketed over the past couple of days. Any thoughts on that, Sam?
I mean, this is more of a betting market. I look at more of the CME Fed funds futures. So that is going to correlate very highly with this. This is a betting market. Obviously, the market makers in this are going to want to be lopsided more toward whatever the CME Fed fund futures are pricing in, which is more of like where the big money's at. But I don't know. I mean, like 11%. 85% chance of 3 rate cuts, a 6%. Yeah, that actually falls in line with it. Pretty much what I'm saying. I mean, SoFi as well as other small caps are really going to move, and this also goes with Klarna as well. I'm also a shareholder of Klarna. That these companies make more money on that delta between what they can borrow against and then what they can loan against, right? So this is how banks work. This is how Nubank works. This is how a lot of these companies work. They want lower rate cuts. Obviously, Nubank is a bit different because it's more ex-US. But, I mean, SoFi obviously has a much longer trajectory than Amazon. You know, how much can you possibly grow a $2.5 trillion company that's growing at about 11% year over year? But to touch actually on what Steve said earlier when it comes to Amazon, the bull case in Amazon is not growing margins in the e-commerce segment. The bull case is growing margins on AWS, but also scaling AWS out. So if you have Amazon growing or AWS growing at 17% year over year as of last quarter at about like 34-35% operating margins, which is going to contract a little bit as they continue to increase CapEx, and that accelerates to what SemiAnalysis and other analyst forecasts is around like 20% plus for 2026, then you're talking about increasing the operating income for a company, and not just any company, $116 billion company as of last quarter. Like that's a lot of freaking money, and the market loves to front run all of this stuff, right? So right now Amazon is trading. It's one of the cheapest med caps as well on a forward price to earnings basis. I don't know if that's really going to change. Like the stock price goes up, that's definitely going to come up more as the price of the actual market cap increases. But the margin expansion story is much more important. Right now, you have basically e-commerce at about like $500 billion plus. They continue to accelerate their investments in emerging markets. Their whole robotics thing, I don't know if that's really going to come to fruition until like 3 years from now, at least, right? Like they're all talking about expanding robotics and everything. So it's much more of a hype scenario than anything right now. But to actually see like a monumental effect of it, because we have at least 3 years out for that one. But the play right now is the data center catch up. They have been contracting growth for the last couple of quarters, with Amazon going from 19, 18, and 17% last quarter for AWS alone. If they expand that one, and we already have the advertising sector already growing at 19%, which is already high margin business, albeit it's not the biggest business they have, but it is high margin. If that continues to accelerate, that's going to like flip the whole sentiment in the stock, right? So like what was once like, okay, we have all these tariffs and everything around, Amazon's going to be hit because it's consumer and all their margins and everything. It's like that's going to change. That's going to change overnight if they show growth in the AWS sector. Because with Azure and GCP accelerate and Amazon didn't. That was like the underlying fear last time. I really feel like that's the all telling sign. If they're not above 18% next quarter, the stock is not really going to go anywhere.
Mm-hmm.
If they're at 17% or slower, then it's going to go down. Yeah. For sure, it's going to go down.
For me, I'm willing to take that risk of is it going to accelerate when you see the operating margins really start to show up with automation and really the operating margins in Europe, I think, start to show up, because right now they over the past several quarters, I haven't checked last quarter and I need to review myself, but last quarter I felt like they were either just slightly break even or even maybe slightly negative, but they're not nearly as profitable on the e-commerce side in Europe as they are in America. So I'm curious, as that kind of builds out in the rest of, say, the international markets, how that brings up the rest of their operating margins, and then you include the automation piece from it, or innovation piece, from what I'm hearing. How that actually impacts the bottom line.
I mean, go ahead. Sorry.
I was going to say really quickly on the European side, the Amazon might actually grow a little bit faster than on the US side as far as e-commerce over the near term. The big hit is the de minimis actually ending for tariffs. And so that's a hang over Amazon. Of course, it impacts Temu and others as well. So it's not just isolated to Amazon, but that's not in Europe. And so that might actually surprise people on the European side. And hopefully it's factored into the sales price on the U.S. commercial side. But that ended in September for everybody. It was impacting the U.S.-China corridor earlier.
What do you guys make of Jassy? Like, that's the thing that I'm interested in. Like, Roy and I have had this conversation a number of times in terms of just his stewardship of Amazon and the appreciation that he's seen through.
Bezos needs to get off his yacht and get back to work.
That's what I think too.
Jassy was the one who brought AWS to Bezos. Like I don't think there's anything wrong with him being a CEO. If you ask me, I think Bezos is still piloting the ship. Like in the last major interview we had with I forgot, Andrew Sorkin, it was basically that he works at Amazon still. Like he has not stopped working at Amazon. He's still running the ship. Like there's no way all this is happening, but it's like, yeah, it's cool, you got it, right? And plus, I would not be an investor in Amazon if it wasn't for AWS. And Andy Jassy was one that originally pitched that to Jeff Bezos. So I have every confidence that Jeff Bezos is going to do just fine at Amazon as the lead or CEO of Amazon. And then also on top of that, Matt Garman, who's the CEO of AWS, he's been there since pretty much the beginning. And he's been the head of EC2. EC2 is basically the VMs that run in Amazon. And that was like its cream of its crop when they first started. Obviously, we've shifted left in terms of all the infrastructure over the last like 10 years where it's becoming more of a serverless infrastructure. But Garmin has been there the whole time. So he knows how to run this company, in my opinion. The previous CEO, can't really speak too much about him. I think he got kind of like more pushed out than anything. But Garmin's been around there for a while. So you have Jassy, who's from AWS, or he is basically the one who brought AWS. And you have Matt Garman, who's running the 35% operating margin business that's growing at 17% year over year. I don't know, like that's probably the best people I could think of. Maybe it's like more of like people attach like the stock price to who's running the ship. So it's like that's person to blame, because I remember everyone was blaming Sundar Pichai. What, like 6 months ago, they were like saying he's got to go, but like, where's all those arguments now that Google's at an all-time high today? Like those arguments are just gone, right? So like, you tell me. I mean, when Amazon hits new all-time highs, which it probably will in the next year at least, are people going to complain about Andy Jassy? I don't know.
I don't think they will. And I think one last thing that I'll say before we potentially move it on, because we have talked a good about this segment. I'm curious to hear if anybody else has any other thoughts they want to bring into the room. One thing that I look at specifically is the operating cash flow more so than the net income. For people that are understanding how Amazon is different than maybe some of the other Magnificent Seven, the amount of depreciation, because you have warehouses, you have trucks, you have all this infrastructure that you need to invest in from a capital expenditure perspective that you're depreciating every single quarter. I look at the ops cash that's coming in. So when you think about the actual cash that's actually hitting the balance sheet, $121 billion coming in specifically in the trailing 12 months, meaning basically from Q3 of 24 to Q2 of 25, $121 billion. And they invested over $100 billion in the last 12 months. I mean, that's insane. And if you compare to what that actually means when you look at the net income, I think only shows 70 billion in the trailing 12 months. So when people are saying, oh, the price to earnings is X versus Y, it's like, actually the price to earnings is, when you think about the actual operating profit and the cash that's coming in, this net income is impacted extremely immensely, I should rather say, by the depreciation of all the benefits associated with all the real estate that they own and the trucks, etc., artificially pushing this down so they have to pay less in taxes. So I like to look at it more so from an ops cash perspective. And if you think about this, Amazon's only a $2.3 trillion company. You say only, but they have $120 billion in ops cash. That's a 20x in terms of multiple. To me, that seems a lot cheaper than if you're talking about 2.2 over 70 billion, right? That to me is the real number that you want to look at. And I think when people see this number of 70 billion, they think that, no wonder why it's trading at a discount to Google. But in reality, I think this should be trading closer to $3 billion stock as it is today, with just what we have in terms of ops cash. And I think that ops cash, as you saw in the trailing 12 months, is growing like gangbusters. I mean, just in the last year over year, it grew over 15%. And so I don't think that you're going to see that slow down. And if you think about that in that perspective, they're able to grow that 10 to 15% a year. They're going to be able to grow that by an additional $200 billion a year, very easily. At no problem, and that's without any ops efficiency gains. Then you have some ops efficiency gains, and it'll be even better than that.
Matt, bring up my screen. So these are the big four cloud players, and we know Amazon's margins are not great. They're trading at a pretty attractive valuation for a company that can completely expand operating margin without adding revenue. And I'm not saying they're not going to add revenue. What I'm saying is they can completely overhaul their internal business through robotics and AI over the next 3 to 5 years, in addition to gaining in AWS, in e-commerce, and moving into big box, going after Costco, and building out their advertising platform, which they've barely tried, and they're already number 3 in the world. So this is a company that can add a lot more earnings growth as margins expand. And as margins expand and revenue grows, they add a lot more profitability to the bottom line. This is going to look even cheaper if that happens. Keep in mind, 11.8% operating margin on the total business. They have 160 billion to 170 billion of general administrative expenses. That's a lot of freaking money that they can drop right to the bottom line through optimizing the business. I mean, it to me, this is a no-brainer.
Yeah, I mean, I've looked at the comparisons, and I'm a shareholder of Meta, shareholder of Amazon. More little leverage on Amazon than any of them. Wish I held Google. You know, I'll be the first to publicly admit that I sold Google probably at the worst possible time ever, but that's fine. But you know, I agree with you. I mean, like, even though AWS is not as large as the e-commerce business, it is very high margin. So if that's accelerating next quarter versus like around the 10% for the e-commerce business, then you're talking about adding more margin expansion to its operating income, right? I mean, that's really what it is, right? So they're going to be increasing their capex, like without a doubt. Largest hyperscaler in the world, they're going to increase their capex, and so every single other hyperscaler in the world. So you have Azure, you have Google, and then Oracle. Like I don't even know like what Oracle's raising like $38 billion. Like they're just running on debt at this point. Oracle is probably the one that I don't want to own right now because they're fun. If you think of like one of those companies that definitely cannot sustain their operating expenses from a profitability standpoint, it is definitely Oracle. Like that's probably the one that I'm the scariest to be in. The scariest to be in, probably the most upside, but the scariest to be in terms of this leverage data center theme that we're in right now. But probably the safest one when you think of the bang for the buck you get as far as the cloud business alone, right? So Google's cloud business is like 10% of its revenue. Azure is probably like around 20%. Amazon is probably like around 20 to 30% of it. But like that's the only reason why I'm invested in this company. Like I would not invest in Amazon if there was no AWS. I would put the money in Mercado Libre, without a doubt. Like Mercado Libre is the one that's growing and probably has a longer trajectory than the AWS e-commerce alone. Because AWS is Amazon e-commerce is already established. Like what else can you possibly do with that? The momentum with Amazon is ads with Prime Video, also with expanding and with their partnerships with other companies as well, but also with AWS. Like that is the only reason why I'm in Amazon right now. E-commerce, maybe, but there are so many other better plays if I'm really striking e-commerce. So it would be C Limited, it would be Grab. We're adding more Grab, even though that's not necessarily an e-commerce play. It is considered of the smartphone penetration to other countries besides the US. Mercado Libre, of course, and then there's other companies as well to be involved in that one. There's actually no, you know what? There's one that Samuel Mercier was talking about in Europe, but at the same time, like emerging markets is the way to go whenever it comes to e-commerce, not necessarily US. Amazon is just AWS strictly and ads.
Interesting. All right. Well, Amazon, I'm buying it. There you go.
So I'm the only
bigger position than I do, dude. If you have 1,000 shares of Amazon, you have more than I do. I'm not at a pool. I'm actually at a brewery.
You own it, Sam?
No, I do. I own Amazon, but I think Matt has probably a much bigger portfolio than I do. Like I'm not like a swimming millionaire like a lot of you guys are. Just the average Joe over here.
You have a lot of positions, don't you? Though you're more diversified.
I've dramatically reduced it as of recently. Like I had EOS, I sold that. I sold Navitas. I've really trimmed my positions down to focus more on like more of the value plays than anything, but also being part of the theme. But I would say a large concentration of my portfolio is either Amazon, Mercado Libre. Now it's Toast as well, Lemonade, and Nebius, of course, and also Iron. I want to grow it, but like that, I cannot catch that thing. I literally cannot.
Yeah. Yeah. I guess I'm the only one that doesn't own Amazon here. It's always been one of those that, like you said, Matt, earlier with SoFi, if you had 25 or 30 companies, SoFi would be there. I'm like that with Amazon, but I own 10. So
yep. No,
there's an opportunity cost. There's an opportunity cost with that, right? Like Amazon's not going to 2x, right? But like you can pick one of these other companies. They're probably going to 2x if you stay in a bull market, you know. But when you think about the amount of risk, like a lot of these companies, you see macro fall off a cliff last Friday and the Friday before that. these other companies are going down like 10, 20%, right? But Amazon is going to go down 20%. It's going to go down 5%, which is still a lot for a $2.5 trillion company. But that's the reason why I diversify, is because it's very hard for me to stomach this kind of volatility, especially like when I'm at a much different age level and risk tolerance than a lot of other people out there.
Mm-hmm. So, Steve, we were chatting about things that we bought. Not sure if you chimed in today with what you had bought. I know we talked about it a little bit yesterday, I believe. Was it yesterday I was on stream with you? I'm trying to remember.
May have been the day before.
Yeah.
Yep.
What'd you
Energy
buy?
transfer, baby. Energy transfer. Getting paid almost 8% on the distribution. It's undervalued. We need a lot more natural gas. There's only certain pipeline companies that can move it. As the largest pipeline network across the country, and I think it's an undervalued gem. I love the distribution. It's part of my income producing portfolio. I bought some more CTO Realty Group. It's a REIT in the Southeast and Southwest. It's a smaller REIT that is trading under book value, and it's paying about 9.5%. And I bought a few other things also.
Yeah, I saw, at least you're on the stream with Amit yesterday. You talked about Schlumberger and Halliburton. Did you actually dip your toes yet, or are those just thoughts?
I'm a Schlumberger shareholder. I have not bought more in maybe a month or so, maybe a month and a half, but I am planning on increasing the position on them. I think the drillers and the wells, I mean, they do so much. I mean, you know way more than me about them. They do so much on an international level. And when you think about where the energy is coming from, we need more of everything, from renewables to traditional resources. And the upstream producers are just going to produce more. You look at the trend for oil rigs, you look at the trend of production by company. Schlumberger is one of those companies that trades at like 13 times this year's earnings. Buyback plan, dividend plan, getting paid over 3% on the dividend. I like it. I actually bought some more Verizon this week also. I think Verizon, I mean, at 38.5, 7% dividend, give me that all day.
So
Verizon, Jesus.
Yeah, well, it's 7% dividend yield if you believe in the company and you don't hate Dan Schulman. I think he'll be okay for the first few years, but man, I would not want to own this company long term with him there. I think he'll do what he did at PayPal, where he just falls asleep at the wheel, and then the company runs aground, and somebody else has to come in and try to resuscitate it.
You realize
he was terrible. He was so bad.
Billion in EBITDA, right?
What's that?
You realize they do $49 billion of EBITDA, and nobody's getting rid of cell phones.
Yeah, but it's commoditized. So like the growth there is limited. The dividend I think is intact. I don't think it'll be terrible. I just the yield. Like if you're doing it for the dividend,
not a growth play. I don't think Verizon's getting past 50. That's not why I'm in it. I think it's going back to 45, and it's paying. I'm locking in a 7% yield on cost.
Maybe, yeah. Schulman did a good job when he initially came into PayPal to do some things. Of course, he was instrumental in branching out from eBay and being its own publicly traded entity. Braintree and Venmo buyouts or purchases, acquisitions. But man, there were just no concrete vision. He doesn't know how to lead a company like this, but he does know how to get the market excited for a little while. So you may be right. If it pops to 40. Steve, you might want to look for the exit.
No way. I've been in Verizon for a long time. It's this generation's utility company. Utilities are paying 3%. Verizon's paying 6.5 to 7%, depending on where it is. It's one of those things where I'll hold it for 10 or 20 years. I could care less. It's not something that I need to sell to get money out of. It just needs to keep paying me. Let me plow the money back into it and keep generating a larger dividend.
Yeah, Schulman's going to screw it up. It'll take a few years, but he absolutely will.
Look, if he screws it up, he screws it up. I have my other dividend companies too. It's part of a very diversified dividend portfolio.
Yeah. So the yield is basically you're capitalizing on the fact that the stock is down to get a higher dividend yield, and that's why you're buying it?
Yeah, 21 years of consecutive dividend growth. They have $8 billion in retained cash flow, I believe, after they pay the dividend out. They are repaying more debt than they are issuing, and they're growing their EBITDA. And I don't see the debt load as a problem because they have a lot of it at low rates. and the high rate debt, they'll be able to issue new debt at lower levels next year and add more margin. So it's not something I'm worried about.
But like, why wouldn't you just buy JetQ? You get more diversification and higher yield for low.
I own JetQ.
No, I know, but like, why would you?
What do you want to talk about? You want to talk about JetQ, JEPI? You want to talk about SPYI?
No, I'm just trying to understand.
I own all of them.
Okay, with the money that you put into Verizon, why are you okay to get a lower return on that money relative to something like JetQ?
Because that's not something where I'm looking at total return. I'm looking at a diversified stream of income because JetQ is not a fixed monthly distribution.
JetQ, it's a call option strategy. Like Verizon's not selling calls against their own company. Like that's very different. Also, you got to think risk tolerance here, right? Like, so Steve is not going to go out and buy Nebius like 10% and sell puts on it. I'm not saying there's anything wrong with that. I'm just saying like these are two completely different risk tolerance factors. Completely different.
JetQ, I actually am not liking their strategy anymore, and I've been considering exiting the position, adding more to QQQI, because what the JP Morgan Asset Management Company is doing is they're running 80% of their strategy in equities and 20% in exchange-linked notes, and they're running the cover call strategy through the ELNs. And the NEOS investment group is doing call spreads, which allows you to participate in the upside when you're in a bull trend. They've actually outperformed JEPI and JEPQ, SPYI and QQQI. And I don't want all cover call funds. Like I want traditional equities in there as a balance. And also I know what I'm getting the growth. These funds can fluctuate. And if you get less volatility in the market and it's stagnant or even a declining, you're generating less income in the future.
And you're not scared that it's going to be a value trap because they're not really growing.
Yeah, but it's not on my capital appreciation side of my portfolio, so I don't care. Verizon could stay at 40 for 10 years. I don't care. I'm collecting the dividend and plowing it back in and generating more income.
Yeah, and like what you're saying there, I think is fine and fair. Like if you're just buying it for a dividend, I don't think they're a dividend king. Schulman's not going to change that. That's not going to go away. What he's going to fail to do is actually help Verizon grow as a business. He's going to fail to help them pivot into the age of AI. He is going to expand, probably, if anything, the workforce rather than reduce it. He's very woke as well, so don't be surprised that there will be some headwinds that come out in a few years just because of some of the policies that he'll implement. He's done it before. He will do it again. He's the same guy. But since you were just like looking at this as like, hey, I'm fine with it trading in this range and taking that 7% yield, and that's not a bad play at all. It's not where I would want to be personally.
Yeah, I mean, look, it's not for everybody. I have a lot of companies nobody on this stream would buy. Like, I don't think anybody would buy Altria Group. No. Maybe Matt would, but I mean, I don't think the three of you would. I don't think you guys would be buying British American Tobacco or AT&T. I own all those.
Salesforce too. I think we're
Salesforce is very undervalued. We can get into that. We can go down that rabbit hole if you want.
You should buy service now instead of Salesforce.
Yes, I like that.
I think a lot of people would like that.
Matt, just speaking of just before Verizon, we talked a little bit about LNG. Curious to get your thoughts on Next here because it's gotten fairly cheap. I mean, I remember it was over 10 a couple months ago, and now it's under 6.
Mm-hmm.
I've been buying.
Can you talk about Next?
No, I can talk about Next. I can talk about VG. I just can't talk about specific parts of VG.
All right, let's go. Let's go.
But yeah, Next Decade, I think what it is right now is that you have a lot of institutional. What's that?
Throw up the chart if you can.
Yeah. I was going to bring up, so the reason why I had Comcast up is that Chris Patel and I were talking about Comcast that has trading less than a 5 PE. So before I move on to Next, it was interesting. It's a $100 billion market cap, 100 billion or so in debt, but makes about 16 or so billion dollars in net income. So we're kind of scratching our heads as to why it's so hit so much. But I think that they're trying to spin off, I think, one of their businesses, and then obviously debt load being a big piece as to why it's being impacted right now, but we thought it was rather interesting. But yeah, this is the 6-month chart for next decade. So Tevis is right. It was peaking out at over $10, $11. And I think that a lot of that was in anticipation of train 4 and 5 getting sanctioned towards the end of the year. And I think when the assumptions came out for trains 4 and 5 and the cash flow expected to coming out from trains 4 and 5, when they came out at a $5 assumption, I think that what the banks were really forecasting was something north of that, closer to $7. And so that means for the spot pricing, and so for people that kind of understanding, it's not an exactly analogous specific to pipelines, but there's basically fixed contracts for a lot of these trains that show up. So the first 3 trains, they have about 92% of the volume contracted. So pretty much what you see is what you get. And then there's 8% of the volume that's uncontracted that they sell at spot prices. And those spot prices, they were assuming, some of these banks, or one of the major shareholders was assuming it's $7. Well, now that next decade is assuming trains 4 and 5 at $5. Now it's assumption. You don't necessarily know until you actually sell those things. They were saying, oh, well, the cash flow is not as great as expected. Well, my assumption for next decade, to be fully transparent, was, one, I was always holding it until mid 2030s. So to me, I think short term, I was never really concerned with the $6 range. And actually, I'm only down 5% of my overall position because I've been buying, at cheap prices, and I only bought a little bit in the $10 range and above on my normal increase in cost basis. So there's that. But then 2, where was I going with that? I was always anticipating that there would be a large amount of share dilution associated with next decade. And so what I was buying this company, I was expecting there to be, in order to fund trains 4 and 5, say, hey, we need $500 million or $1 billion in cash. We're a $2 billion market cap company. Let's sell half of our shares on the open market and get $500 million in cash to fund these two trains, right? Well, they did not do that. They were able to figure out a way and maneuver a way to keep 100% of the shares as expected. Yes, there is some dilution, but not nearly to the extent, not the 50 to 100% share dilution that I was expecting. But that being said, that impacts cash flow slightly. So on a project level, so if you think about it, the project level is going to be what it's going to be. And so what ends up happening is the net income to next decade ends up being, you have to think, the net income to next decade, you think about it, per share ends up being preserved because you're not diluting shareholders 50 to 100% per share. But on a project level basis, it goes down by $100 to $200 million. And so overall, if you look at it on a project level basis, it doesn't look good. But the fact that you're only sacrificing 10 to 20% of your cash flow and not diluting shareholders by 50 to 100%, which is what I was expecting, is a positive. So to me, I actually think that this is a huge win and actually better for the long-term opportunity, for me at least. You guys need to do your own thoughts as to whether or not you think it's beneficial. But I was expecting much more dilution, which when I was looking at the company, I was thinking it's going to be a $20-25 billion market cap organization, but you're going to have twice as many shares. So you're going to go a 10x, but divide it by 2 because you're going to have double the share count. So you're only going to have a 5x. I think now you might be looking still at a 8 to 10x because of the fact that you're not getting that share cut in half. Now, of course, there's a lot of still other things that need to happen for it to get to that $20 billion market cap, but still very bullish overall. But that's the main reason for the tanking of the stock, is assumptions that people had. And I think JP Morgan came out today, or somebody else, Bank of America, came out today with a $3 price assumption for the margins that they were get for spot pricing. And that's just absurd. In my opinion, that means that you're going to either have Henry Hub trading at north of $8 in MCF for the long term, and or Japanese or European markets trading at at $8. So one of the two, and I don't foresee either of that happening in the next 10 years.
Why do the spot prices vary so wildly, Matt? From 3 to 7, like that's a massive spread. The assumptions, I mean.
Roy, what are you bringing up?
Maybe answer Tevis's question along with this, but I don't know this company at all. I know that this was tariff related, and you talked about this 50% decrease basically in the last 3 months. But it seems to happen about the same time, at least the last couple of years. Is there a seasonal aspect to this business, and that's what we're seeing there?
Regulatory. So it's regulatory. So it's zero revenue right now.
Yeah.
So last year, what the reason for that precipitous drop was the fact that the Biden administration, or the Department of Energy really, was putting their based off of what was an environmental study. They basically said, oh, they haven't done enough work, right? And so they put pretty much the license at pause. Well, they went through the courts, and later that year, which is when you saw the run up to $10, they basically said, yep, you guys are good. Everything was fine. They submitted all the supplemental information that they needed. They did the supplemental environmental study, and everything was fine. But basically they said it's like, you didn't have enough of town halls for people to claim, oh, this is going to ruin the duck feeding on my land, and this, that, and the other, and emissions, etc. And so I guess that was the complaint. And so they went to trial and basically said that was BS, and they did everything that they should have. But yeah, most of the time it's regulatory, and because it's zero revenue, any sort of news event like this cause a massive swing, because you don't have any fundamental revenue or anything to kind of fall back on.
Right. Okay, thank you.
Yeah, Tevis, you asked something. Oh, the spreads. So you have to think there's a lot of cost associated with this. So you could do multiple things. You can actually own the LNG facility, like NextDecade itself, or you can just specifically own the boats that take the LNG specifically from the Gulf Coast to wherever you're, say, regasifying it to. So in the case of most places, it's TTF in Europe, the title transfer facility in Europe, or in Japan. But you have to think it costs money to kind of get it there. So what you're doing is you're paying, let's say, you're paying to get it on the boat. So at $3 Henry Hub, you have to pay somebody $2.50 plus a little bit of premium to put it on the boat itself. So you might be buying it at $3.50 plus $3 to kind of get it on, plus shipping fees. You're now looking at pretty much all in costs at $7. And then you have to ship it all the way 2 weeks, 3 weeks time to go to Europe or Japan, depending on where you're going. And so that's where you're getting, and you're selling it potentially for $12, $13, $14. That's your spread. And so you might say, oh, well, the spread is from $3 MCF at Henry Hub to say 13, so that's $10 spread. But you have to keep in mind the fixed fees that you have to pay for the liquefaction costs. And so some companies specifically only want to focus on the shipping piece, so getting it on the boat and then worrying about that 2-week journey. Other companies like that fixed fee piece of it, because they could say, hey, I know it's only 10% or 11 or 12% rate of return, but it's a long cash flow and I can guarantee that. And especially if I can figure out the financing piece, I can get that, annualized return, and, over time, I can pay it back over a certain amount of time, refinance, extend it, debottleneck, etc., and maybe get that return on invested capital up to closer to 20%, etc. Some people like to do both. Venture Global likes to focus on both with the actual facility as well as the train. And some companies actually like to do all three, which is owning the upstream assets, the actual gas wells that produce it. So basically figuring out a way to develop it for as cheap as possible, get the gas out of the ground, say in the Haynesville, the Permian, the Eagle Ford, then own the actual facility that exports it, put it on the boat, and then actually get it to wherever it needs to. And then some of them actually like to own the regasification plants themselves. Each one of those places has its own margin associated with it, right? And value chain associated with it. So I like the fact that it's very stable. There's a lot of good success that we have here in the United States with LNG so far. And what I've seen, I shouldn't go too much detail with this, but what I will say is I do a lot of studying of where gas is being developed around the world. And what I am seeing is with people truly lining up with the Paris Agreement and regulatory environments in certain countries, you're not getting nearly the energy supply that you should out of most places. And then that requires you to say import for most of your energy needs. So you have places like India, Japan, Korea, most of Europe, all in drastic need for imports, and especially going to the 2030s and beyond. And you have people that have been predominantly dominant in providing gas supply, specifically India having good gas supply right now, but going into the 2030s, unless they find more gas, maybe not so much supply going forward, and demand continuing to increase. But Australia has really good supply right now, but without further exploration will really drop off into the 2030s. So very bullish specifically on natural gas in the United States.
That's
I think a lot of people. Oh, go ahead.
I was going to just say, interested in energy definitely next year. A lot of demand. Some energy plays have ran incredibly high, and others seem like left for dead. I think we just need energy. So I appreciate that, Matt. That's I have to go back and rewatch and do some research here, but that's all the time I had today, guys. So I just wanted to say, talk to you later, and we'll see you guys around. Thanks for having me on.
Yeah, much appreciated.
What's that?
You coming on tonight?
Yeah. Oh, yeah. For anybody that's a SoFi investor, Steve, Tevis, Tanner, and I, maybe Chris as well, will be doing earnings preview at 10 o'clock Eastern time. So join us.
I think Chris is at a wedding right now. He might not be able to join. We'll see. I'll tune in and watch you guys later.
You're leaving, Sam?
No. I'm just saying I'll watch you guys later. I'm going to be busy tonight, but I always got the earpiece in, listening to you rascals all over here.
Matt, let me ask you something. What next? How are they getting the LNG?
Pardon?
How are they getting the LNG?
Actually, Enbridge. Sorry, go ahead.
No, Steve, I think your input has switched to maybe a laptop or something.
Oh, my mic was not in front of me. Sorry. Good call. So, Matt, I just want to hear one word.
Were you fapping
the LNG?
Were you fapping, Steve? Is that why you had to move it?
No, I was typing. That's why I was on mute.
Enbridge.
Pipelines.
Enbridge.
But yes, Enbridge. What a great company Enbridge is.
Enbridge does a good job.
They're a triple threat. They're the only pipeline company that owns utility companies. It's amazing. And the North Carolina utility company that they purchased from Dominion is right up against freaking Washington, D.C.
That's why they pay the big bucks, Stephen.
I'm just saying, there's plays out there.
Sam, you're not much into you're mostly tech, aren't you? You don't really focus on the infrastructure stuff.
Actually, I'm very bullish energy. I think a lot of the market is really ran with like the speculative nuclear companies. There's probably like 2 nuclear companies that I would be fine investing in for long term. That's CCJ or Cameco, as well as CEG, Constellation Energy Group, because they're actually getting revenues from this. Also, there's Citron. There's I forgot the name of the company. LEU is the ticker. I know I have a couple people who are bullish on that one, but Oklo and all that, like, it's just, they're just running with momentum at this point. I think these companies, like, they don't have any revenue. They're based on revenue they're going to get. It was probably a good buy at some point, but now that's all been priced in, and the assumption is there, right? So, like, they either show up or they don't, or the market runs with high momentum, high beta plays, and they keep running. But at that point, I think it's like more of a trade or a gamble. But for long term, I think the play really right now is LNG. Like I don't, what I don't understand is like the market's running so hard with nuclear, but they forget like it's not a sustainable energy provider to be in nuclear right now. Like right now, right? If you think of the the more carbon neutral you can get right now in terms of the cost of actually utilizing it is really liquefied natural gas. You know, obviously there's oil, but that's not really favorable for a lot of companies right now because the price of oil is so low. However, when you think about like what's available right now, what do we have a lot of in the U.S. and also what's mispriced? I think that I've had Next before. I was buying it actually a little bit higher from here, and I trimmed some when it was like around $10, and then VG the same thing around 15, and I'm buying it again. You know, like this is just mispricing in the market, and they're seeing the news that's recently out right now in the market tends to be very they tend to be forward looking, like very short degree forward looking, like maximum 6 months, and they take account of like what they're actually seeing. And right now the market hates these stocks, right? They hate Next, they hate VG, but there will be a time again where they come back. And in my opinion, I think the floor is not really that far from here at all. But when you look at these other stocks like Oklo or something, like this can go down a lot, right? Because they don't have any recurring revenue right now whatsoever. Like Oklo can go down to $20 and nothing's changed other than macro market, right? So like that's the scary stuff with these stocks. Like liquefied natural gas has been around for a while. We're the number one exporter in it. Like, where is it going to go? Like, this business is going to be sustainable. They've been around for a long time. Same with Next as well. Like, they're going to build these other trains, right? So it's like, has anything changed? Not really. Sentiment probably has changed the most, and that really is what moves stock prices.
Interesting. Steve, you noted that, well, first and foremost, Tevis, did I answer your question? I want to make sure I didn't dance around it.
No, I think it was a good answer.
Okay, thank you. Yeah, Steve's audience didn't like it. They said it was too long, but they can eat a dick. No, I'm just kidding. Steve, I'm curious. Did you ever end up buying any Next, or did you end up? No, because you hate me, or just because you haven't done enough due diligence?
I haven't had time to really. I've looked into it. I like what I'm seeing. I haven't had the time to really get down and dirty with it, so I need to do more on it.
It's fine. No, I just think that it's something that you would. It's tough, right? And I think Sam is 100% right? You have to analyze, and I get this question a lot, right? Specifically about this. We don't have to talk about it. We can move on. But I'm going to make the statement of people always ask me, like, Matt, VG or Next, VG or Next. Actually, here, with the certainty that you can get from VG having actual revenue coming through right now and the cheapness of the stock, maybe I should pull it up at this point. But the stock has taken a big dump because of the arbitration, which I can't talk much about. But the piece about it here, it dropped, as you can see, very extensively from like $13, $14. I actually took some profits here in I believe it was the June, July timeframe and moved it over to next decade because I had bought before it went on its run at the $8 or $9 range and took like a 50% rise in a lot of my shares. And I said, well, if I'm going to be betting on something in LNG, I'd rather have more in Next. So I didn't liquidate my position in VG. It's just when it got to a $35 billion market cap, I'm like, okay, well, in terms of market cap, VG was a 3x, but I thought Next would have been potentially a 5, 6x. So I readjusted the portfolio. But now that you're back down to $9 again, you know, you kind of get that opportunity to be closer to a 4.5x potentially for VG in the long term, plus buybacks, etc. And so with that, if you think about certainty, you're already producing revenue, and they have a different way of bringing on facilities comparatively than say Cheniere and Next Decade. So that alone, I think, is something that's interesting. So I've been buying Venture Global again. I was pausing, not like in a big way, but I was putting more money into Next over the past, say, 3-4 months until this drop. But now I think it's a no-brainer. If anybody that is kind of risk avoidant, VG is probably a better buy, but I think Next is still in the long term a great opportunity. But it has that risk associated with not having revenue, cost delays associated with LNG facilities, which are kind of famous for cost delays, as well as just startup delays. So that all has impacts on the IRR, the investment internal rate of return. And you keep in mind, even if it gets delayed, the interest rate doesn't stop, right? The interest payments on those things are still due, regardless of whether or not they start the facility. So, yeah.
I mean, one of the things about Next that's actually very interesting. I apologize for the noise in the background. I'm at a brewery, guys. I apologize. But one of the interesting things is that if you look at the investors who are in Next, who have invested in Next, one of them is Saudi Aramco, right? Like, they don't really place their bets in speculative companies. They've bought their energy ahead of time. They've bought their containers ahead of time as far as Next goes. And I have to be completely honest. Like, I don't want to say that I'm going risk off, but like when you see the market really running as hard as it's been for a while, this is the time for me to rotate some money into some value plays, because this isn't going to happen forever, guys. Like, the market is at new all-time highs today. I'm not like the most riskiest person out there. I think there's plenty of companies that could probably continue running. But that being said, like, I'm not an investor of Oklo, or I'm not an investor of EOS right now. Like, I might have left money on the table, but there's a lot of companies out there where, let's say the market falls like 5 or 10% from here, which I'm not going to say it's going to, but like, what if it does, right? Like, what if it does? It can happen. Like, it can easily fall 4% lower from here, which it just did 2 weeks ago. And how many people will really be surprised if that happens? And then you go ahead and look at these other value companies and like, how much have they dropped? They have a much lower beta versus the S&P 500. So are they going to drop as significant as the S&P 500 goes, especially a lot of these growth stocks? Probably not. You got to kind of, I'm not saying like to sell everything. I'm just saying like, just be mindful, right? Like, not everything goes straight up. And when things go down, usually Verizon and all these low beta plays that aren't really as popular out there, that I know Steve is in a lot of, is going to be the ones that money rotates into as far as defensive adjustment. So I don't know. That's just the way that I see it. If I was in my early 20s, I wouldn't really give a shit.
Yeah, I think it's all how you're positioned. And look, that's one of the reasons why I'm really diversified and I don't take big gambles. Market go down 10 or 15%. You could have a lot of these companies get whacked 50%. I'm not really going to feel it, because I'm very diversified. I have a lot of ETFs and I have a bunch of different dividend plays. So, I mean, I can't predict what's going to happen. I think my premise is staying the same right now, that the large caps are going to get larger. And when I say large caps, I mean the mega caps. I just don't see a lot of companies that can compete with them. I think they're just going to get bigger. And I do think 2026, you could see exactly what Sam said. This be a market where you have a broad market rally in some degree. And companies like Coca-Cola, Procter & Gamble, and Verizon are going to surprise people. And I do think energy is going to catch a bid at some point. Not the smaller upstream producers, but when it comes to exploration and production, I got to tell you, I'm liking Chevron more and more and more, especially with the Hess acquisition. Like, that's not even in the numbers. So there's some stuff out there I'm getting very interested in.
Yeah, I mean, people forget that in 2022, and I'm not saying there's going to be a bear market, but in 2022, energy was the play. And I know a lot of people looking at like Enphase with a lot of the solar. I think that was a completely different scenario, because rates were very low at the time. And yes, they were going up, but the secular theme of people like diving into solar, trying to lock it at lower rate as far as their high debt that they'd have to take out in order to build a solar panel on top of their house. I think a lot of people were generally like diving into those companies and confusing that with the entire energy sector. But oil was like above $100 a barrel. during that time. And a lot of these oil stocks were just rallying hard. Meanwhile, tech was just falling off a cliff. You know, the market has like this circadian rhythm where it just goes up and down, right? But the people associate up and down with like the whole market, but that's usually with growth stocks, because growth stocks generally, like, what did we say? Like, it was like 67% of the entire market, right? So if Amazon, Apple, Google, and everything's going down, money rotates into utilities, it rotates into staples, it rotates partially into energy, but mostly like the defensive stuff. And that's why it means a lot to have like a balanced portfolio over time. So then that way you're kind of getting the best of both worlds, but then your tech or growth basket is growing exponentially higher to kind of make up for that, right? Because when the market goes down 10%, I don't know when, but when it does though, like if you're all in on all these growth companies, you're going to get murdered, right? I think a lot of people felt the pain last Friday and the Friday before that and earlier this week. But how do you feel about that? I think that's something you kind of got to kind of gauge with yourself. Like, do you feel okay with that? Because there's people who are like, oh, 10%, 20% swings in my portfolio every day, that's fine. But then there's people like myself where it's like, I can't stomach that. So I need to kind of put my portfolio in a certain position where it's like, I'm okay with this type of volatility.
I think it comes down to what your risk tolerance level is and what you're okay with swings. I mean, you have some people that are just 100% in S&P 500 index fund. They're like, whatever happens, happens. And then you bring up a great point, Sam, because look, 2021 was a great year. And then 2022, forget Amazon and Alphabet being down 50%. And we had Apple holding up the market, and they were the last domino to fall. And they ended up taking a 40% haircut. Think about what happened with Palantir and Robinhood and SoFi. I mean, SoFi went under $5 at one point. So, you know, there's a lot of people that are in a lot of chips in very concentrated names. And if you get a rotation or you get a recession, it could absolutely trigger something. And you have it when you allocate capital to companies, you have to understand the risk and what could happen. And that could absolutely happen. And the one thing I say is, for myself, don't do what I do, but I position myself where I have a lot of chips spread a lot across a lot of different things. I don't put a lot of chips in just one or two things. So it helps me sleep at night. And I have a lot of different ETFs in there also. So it definitely helps me balance everything out. And if the market takes a 10% swing, I'm probably going to be right around there, maybe even do a little bit better, because you know, some people won't like this, but I have some stuff in VEA, which is the International Vanguard Fund. I have stuff in SPEM, which is the Emerging Market Fund. You know, I have the dividend funds like SCHD and VYM. So there is a method to the madness. I don't need to bat 1,000 on every single position. Like, there are things that I do for peace of mind.
Yeah, I think it goes back to, you kind of have to work on what works best for you, right? And where you are in your investment career, right? When I was first initially getting started out, I was more focused on security and trying to make sure that I had some sort of dividend income. And then, you know, once the portfolio got large enough, I was like, you know what, like, I'm still super young. Like, why am I not trying to play a little bit more into the growth aspect of things? And that turned out very handsomely for me. And now that I'm kind of at that place, I always think about it. I'm like, well, maybe I should take some off the top and move it over to the safety pile again. And it's like, well, if I just put it in that, and then I could ride it up. And it's like, but at the same time, what do you want to do, right? And it's really up to your discretion. And sorry, I'm about to sneeze, and I hope I'm not trying to. But yeah, there's some people out there, like, they don't necessarily need to be focused on hyper growth. Like, maybe they sold a company for 20 million and they have a very simple lifestyle, and they just want to make sure that their money stays in safe hands. Maybe they shouldn't even look at equities at all. Maybe they should be more focused on CDs, or maybe they should be focused on corporate bonds or treasuries, where they could guarantee that their principal stays intact and they're getting, 5% a year, rather than potentially focusing and risking the principal by trying to get 5% or more. So it really just depends on what people are doing and what they're trying to do. And I think oftentimes people are more so focused on trying to get into hyper growth when really they just need to get their money right on a monthly basis. And I try, I say that tongue in cheek, kind of, but it's real. Like, I think sometimes people say, okay, I somehow figured out a way to get $1,000 in my bank account. I'm going to put this in the stock market and grow it to $1 million. When in reality, they need to figure out and have good money habits, right? Like, you expect your businesses to have, that you invest in, to have good money habits, but you yourself don't have good money habits. It's like very counterintuitive. And so I hope that people kind of think about it. It's like, well, I'm looking at the cash flow statement for this company and I want it to be good. Give me 1,000x, but you can barely save $5 on your own. So it's like, you kind of have to have that millionaire mindset before the money shows up a little bit. And that's something I talk about pretty frequently, but I don't think that people fully have digested that a little bit. I think there's a lot of geniuses in this market right now, and I haven't seen this many geniuses since 2021. And I feel like we're going to see a lot of issues when things unfortunately peel over. But fortunately, I don't think it's done. I think we're hopefully going to hit a run for 7,000 before the end of the year.
I also don't think like a lot of people have an idea of what their end goal is. Like, they don't have that very clearly defined. And I think just psychologically, it's very difficult to imagine ourselves 10 years from now, or what we're going to like to visualize it. And I see it with so many people around me that are investing. And I ask, like, hey, what's the goal? And the answer is more. Well, a lot of those people, some of them have made enough to afford to take risk off the table and coast and live a very comfortable life well within the means of what they've established their expenses to be, or what their life goals are. And yet it's very coaxing, this idea that like the market, like it's almost like a dopamine hit to some degree. But I just think that like it should be in correspondence with your goals. If your goals are, hey, I want to hit 5 million, let's say, and you hit your first, 1 or 2 early, well, it's like, great, you should adjust to that goal. If you want to hit 5 million and that's what you want for your life, and you've determined that as a goal, and that's what you're working towards, and you have that sort of, on the what do you call it, the visualization, and you're at 4.8 and you're not going into wealth preservation mode, well, it's like, well, is that truly your goal? And so I think a lot of people are just like taking unnecessary risks relative to their sizing. And sometimes, I mean, like, I had relatives who just wanted to start investing for the first time, and I say, hey, look, like, your habits are your most important thing, because like you're never going to grow your way out of, like Matt's example, 1,000 to 100,000 or 1 million. Like, good luck trying to do that without taking on insane amounts of risk. But once you've set those habits, then determine, like, what do you want out of this experience, and what is the point at which you like are at the end of your journey, so that you can move into the dividend plays and the super safe stuff, and stuff that won't keep you up at night.
You're a good man. You're a good man.
I think we should do a full stream on investing philosophy and strategy at some point.
I love content creator Steve, man. This guy has some he's just like, we should cover the UFC. We should rank our movies. We should.
Tevis, you're coming tomorrow night. We're covering the fights, right?
Isn't it during the day tomorrow?
No, is it?
I think so.
Don't do that to me. Does that mean we have to do 2 streams tomorrow?
Hold on.
I'm going right now.
I'm just trying to be cool and like trying to keep the community going, because Amit, I found out like 10 minutes before I went live that he wasn't feeling 100%, and I was like, damn, like that's not cool.
2
And then Steve comes on and he just starts siphoning off viewers from me like he runs the fucking place. And so I'm just seeing my count go from like 850 to, and then Steve's is just going from 500 to 6 to 7. So
wait, did Steve stream this to his audience as well?
Yeah, he's a goddamn gangster.
Steve, you're a guest, man. Don't steal his viewers.
Nah, Steve deserves it. He's everybody that isn't following Steve as of yet, be sure to do that. He's the newest, and he'll eventually need to be bought out by a Mitt, because otherwise he's gonna take over.
Milk Mob Media needs to be acquired by AK Media.
Exactly.
Steve
100%.
made a thumbnail and everything. It's crazy.
Dude, I got 3 live streams set up for the weekend right now.
Steve's
We
a
have to
champion.
add a 4th.
Wow.
Steve's a champion. But yeah, anybody in my channel that hasn't followed Steve yet, be sure to go ahead and do so, and Hot Tevis as well. But I don't have anything else. So you guys, I'm more than happy to stay on. Whatever you guys want to chit chat about.
We can wrap here if you want. Well, I would love to take a look at your movies tier list that you guys made, because I didn't have a chance to join last time.
Yeah, so I'm gonna.
And then we can wrap.
I'm gonna throw the invite out privately later today for tomorrow. You got to come, because we're gonna do some tier lists tomorrow night.
Yes.
Like, it's gonna be like we're gonna do like a serious movie tier list tomorrow night. Tanner's gonna come. You're gonna come. Matt's gonna come.
I'll actually get some. I just like last week. I'll get. It was so fun. I went on a little milk and cookie adventure.
I'm going to the bakery tomorrow to get cookies. Like
I think that was. Did I eat anything? I had food earlier that day. I had something light. No, that's a lie. I just had something lighter. I didn't have like a full meal, but I had that the almond stick, and it was actually pretty tasty. I'm not gonna lie, but I was disappointed. I remember the older I get, Steve, maybe I'm wrong on this. Maybe you can slap me in the face. The older I get, like the less I like potatoes. I don't know why.
It's a staple.
Yeah. I mean, I think it depends. I think you eat at some very good places, so I think you're so used to garlic mashed and just fancy. I'm used to it. Like regular potatoes is, you got to cook it with garlic butter and cinnamon. Yeah. Like there's a whole science behind it. I believe Chef Paul is coming on Tuesday night to talk food with me.
There you go. Yeah, I think for me, yeah, Steve's out of control.
Yeah, no, I'm serious. Like we're freaking my channel. We go down rabbit holes.
Steve running a conglomerate media company.
I talked to Chef Paul on the phone today. We're setting it up for Tuesday night. So
I think what it is maybe it's like wings down here in Houston. Like I still eat wings all the time, but like I'm so disappointed by buffalo wings here in Texas. There are a couple places where I get them, but like growing up in the Philadelphia area, like just the buffalo wings I was able to get back there are just absolutely phenomenal. And same thing with like cheesesteaks, right? Like, and hoagies, not subs / heroes, but hoagies are absolutely delicious. But here down in Texas, like po' boys can be okay, but you can't get like a good hoagie. Anyway,
Tevis, may I ask you something?
Always.
Do you like pizza?
Who doesn't, dude? Come on, what question is that? It's
and Matt likes pizza. Like, so when you guys come up, I want to take, besides going out for steaks, I want to take everybody to this place.
Whenever Matt is in New York, I will be in New York.
End of November. What are you doing?
Done. I'm there.
So this is where I want to take everybody, because it's the best pizza in Manhattan. I promise you.
I'm there, Steve. Whenever Matt's there, man. Like I'm easy.
Just wait to see what this. What do you freaking pop-ups? It is so freaking incredible. This food. I mean, I will take everybody here. It is insane, and then we'll go for steaks later in the day.
I'm kind of curious because I was on Bleecker, but obviously Bleecker is a long street. So I'm actually curious if I was close to John's on Bleecker.
I mean, were you at the bars?
Yeah.
Yeah, you were pretty close.
Oh, that looks so good. What the heck? I haven't had dinner, so this is torture right now for me. Because I jumped on Matt's stream without having straight from work. And it's really freaking good.
Chef Paul and I went here and we killed 2 pies.
Oh, that's amazing.
Yeah.
It is incredible.
Was I close?
This is a crazy advertisement for this place, by the way, Steve. We have like 1,400 people watching. Like, you gotta
That's what I'm saying. It'll be fun to like. I need to visit Steve. It was good seeing him. Steve was distracted when I saw him. He made room to see me.
Yeah,
He only had probably like 20 minutes, but he squeezed out like an hour and a half to come and hang out with me and
I had
get
some
lunch.
shit going on.
And he got like 15 phone calls. I shit you not during our lunch.
He's a busy guy.
He is.
But yeah,
Steven
if we
with the
planned an
business.
event in advance, I'll take the day off and we'll freaking go on a food tour.
Done.
Dude.
Like, let me rephrase that: food comas.
Yeah, done. Matt, it's all on you, man. Whenever you're in New York.
New York, concrete jungle where dreams are made of. There's nothing you can't do.
Dude, it is the concrete jungle.
They make it easy, man. The flights actually are super cheap. You know, I can
You gotta
actually
go
make
soon,
it.
man. I hear pizza might be banned in New York soon.
Wait, what?
What?
Government-owned grocery stores. Sorry, we shouldn't go down the politics route. I'm like, people already hate me enough on Steve's channel.
Dude, people are freaking talking about Prince Street Pizza's great, by the way. Like, I gotta tell you, the chat knows about pizza in New York. They know about pizza in New York. I will tell you that.
I would do a New York meetup for sure.
Yeah, let's do it, Steve. Yeah, when? We gotta let the people know so that they can also join. We'll close out this pizza place.
That's true. I don't know. It might cost a lot to close out John's.
Yeah, sometimes you can't even get in.
Oh,
You gotta wait. Like, it's legit.
Man, I'm upset. I was close. I was close and I didn't go.
Yeah, we'll schedule it so Mick can come. You guys, we'll figure it out.
Oh yeah. Cool. Let's wrap there. I gotta have food and then go back live in a couple hours.
Oh, good.
Along
man.
with Steve.
Did you even see? Did Steve show you the movie thing?
No, we're gonna see it tomorrow. Steve's gonna
No,
invite me.
we're gonna do it live. I'm gonna send a
sorry.
link to everybody. We're gonna do it live, and we'll talk stocks for like 20-30 minutes, be a little serious, and then we'll get silly for a couple hours.
So hold on, Steve. This is my request.
Yep.
I want to rank the movie tier list without having seen the one, because I haven't seen the one you guys made on Wednesday.
Yeah, so it's
I
not
don't want to
public.
be biased. I don't want to be
I
biased.
didn't save it. I didn't save it.
Perfect. Done.
Mm-hmm.
Okay. Yeah.
I
It's
mean,
on
there's-
Amazon and YouTube channels.
It has everything. I mean, they have fast food tier lists, everything, Tevis.
I love that.
It's crazy.
Yeah. Okay. Great.
Very good.
Love it. Love it. This is great.
Appreciate you coming on, Tevis. It was a nice surprise to see you in the chat and be able to make it on. I wasn't sure if you were home. For everybody that's watching, please follow us on Cashflow Chronicles. If you're interested more in Next and VG. We did emergency episodes a couple weeks back, me and Chris Patel. So be sure to check that out. And of course, if you haven't followed the Milkman himself, be sure to do so.
Milkman.
Yeah. Steve, are you staying on? Or you getting off?
No, we'll wrap.
Okay.
I'll write an article before the SoFi Weekly thing.
Okay.
Oh, I forgot. It's not called anymore. The FinTech Friday or whatever it's called.
There you go.
Hell
Cool.
yeah.
All right. Thank you all. Much appreciated. If you guys want to stay backstage and chit chat or anything, let me know. But I'm going to play an outro.
All righty.
Thanks,
everyone. See you at 10 o'clock tonight.
10 o'clock tonight for FinTech Fridays.
10 o'clock.
Cheers.
That's my quant.
Your what?
My quantitative.
You show me a pay stub for $72,000 on it, I quit my job right now and I work for you.
Be first, be smarter, or cheat.
I'm not fucking leaving!
Sell it all today.
Or look at this thing. It's beautiful!
Welcome to the fucking show.